Bangalore Chamber of Industry and Commerce. We welcome you all for the session on tax deduction at source, recent developments and practical issues, organized under the aegis of Direct Taxes Expert Committee. The Chamber acknowledges the support of Madam Preeti Garg, Chief Commissioner of Income Tax, TDS, Bengaluru, for accepting our invitation. Welcome, ma'am, and thank you very much for being here and providing us with your insights. May I now request Mr. K.R. Sekar, our immediate past president and partner Deloitte Touche Tohmatsu India, to take over from here. Over to you, sir.
Thank you, Rupa, and very good morning to all of you. And on behalf of Bangalore Chamber of Industry and Commerce, we warmly welcome Chief Commissioner of Income Tax Director at Source, Madam Preeti Garg, Mr. Srinivas, Commissioner of Income Tax TDS, Mr. Ravindra, Chief Commissioner of Income Tax International Taxation, and his team for joining this interactive session on tax deducted at source. We Bangalore Chamber of Industry and Commerce always takes pride in organizing some of the best programs under the aegis of Direct Tax Expert Committee. And my committee chair, co-chair, both Sunil, Sriram and Nithya put a lot of efforts in organizing today's program. The purpose of today's program is to have a facilitated interaction session on tax deducted at source, which is the core and most important for all the taxpayers. Because any failure to deduct tax at source, which is the responsibility of the taxpayer, will lead to penalties and various other taxation issues, including disallowances. And taxpayers, we are fulfilling the responsibility of the Income Tax Department as a drawing and disbursing officers, and therefore our role is to facilitate and help the tax department on complying with the provisions of tax deduction at source. In this connection, I would like to place on record that Bangalore Chamber of Industry and Commerce is at the forefront in interacting with the department, with the Government of India and the Ministry of Finance for providing various suggestions on tax deducted at source, including rationalization of TDS provisions. In fact, just before 3 months before the budget, we had a very detailed discussion in the Ministry of Finance, and we presented a policy paper which includes rationalization of tax deducted at source. So we are at the forefront in providing practical solutions to the practical challenges that is faced by the taxpayers. I also would like to compliment the TDS Directorate in Bangalore, headed by Madam Preeti Garg and supported well by Mr. Srinivas, for providing a phenomenal support on issuing lawyer tax deducted certificates, dealing with the taxpayers' challenges on the TDS, and they have been at the forefront and they have been extremely proactive. And I have had a lot of very pleasant and personal experiences with both Commissioner and the Chief Commissioner of Income Tax. And on behalf of Bangalore Chamber of Industry and Commerce, I thank them very sincerely for taking these proactive steps. And Bangalore is on the last year, Bangalore was numbered second on the tax collection. I was told on 30th March, Bangalore was just few lakhs below Delhi for the number 2 on tax collection. I hope by 31st March, Bangalore has surpassed Delhi on that. As how yesterday we beat RCB, we beat Mumbai Indians in cricket. I hope one day Bangalore will beat Mumbai in tax collections, also become number 1. And that day is not far off because Bangalore has got a solid tax team and very good tax administrators and officials. And Bangalore being the e-commerce business and the startup capital, Bangalore faces a lot of challenges on issuing a lawyering withholding tax certificates. But I should compliment the Commissioner of Income Tax, Srinivas, and his team, as well as Chief Commissioner of Income Tax, for making all the issuance of certificates online. And we have been getting extraordinarily a great support from the team. Ma'am, thank you so much, ma'am, for being a great supporter of us. And we assure you our support from the compliance perspective. Last, before I hand it over to Sunil, I would also like to place on record that Bangalore Chamber of Industry and Commerce and my team, particularly Sunil, Tapti and Sriram, will help the department to iron out any challenges with the taxpayers. We'll try to address any issues that the department has got with the taxpayers, as we sincerely believe, the chamber and we all professionals believe that anything permitted within the four corners of law is well permitted, but anything outside the law will never permit, and we will never encourage that. So with that, ma'am, we assure you our support, our cooperation in making sure that we both walk together in this path of tax compliances with highest level of integrity, ethics, and values. With these few words, ma'am, once again, I welcome you, Mr. Srinivas Bidari, Commissioner, and your team, ma'am, for this very interactive session. Thank you so much, ma'am. Thanks, Tapti and Sunil and Sriram, for organizing this. Back to you, Sunil.
Thank you. Thank you, Sekar. Um, Good morning, everyone. It is my pleasure to welcome all of you all to today's session on tax deducted at source, recent developments and practical issues conducted on the aegis of the Direct Tax Committee of BCIC. Over the next 3 hours, we'll cover tedious issues and challenges related to domestic payments, international tax, and CPC. Yeah, I'd like to thank Madam Ms. Preeti Garg, Chief Commissioner of Income Tax TDS Bangalore, for agreeing to be the chief guest and to give the keynote address. I'd also like to thank Mr. Ravindra Sai, Chief Commissioner of Income Tax International Tax, and Mr. Srinivas Bidri, Sir, Commissioner of Income Tax TDS, for agreeing to participate in our panel discussions. I'd also like to thank all the income tax officials who joined the session today. Um, I would thank the industry and professional colleagues who have graciously agreed to participate in the panel discussion, and other committee members of BCIC, and all members and participants who have joined this session virtually. Like Shekhar was mentioning, TDS is one of the most important compliances for any income tax SSE, and given the various sections in the income tax law specifying different rates for different nature of payments and thresholds, it is fairly complicated when SSEs need to look at what is the right amount of tax rates that need to apply on every transaction. And over the years, we've only seen an increase in the number of transactions that are now subject to TDS. While all of us as taxpayers and chamber members have looked at simplification over the years, like I mentioned, the number of transactions which are now subject to TDS have only increased. And most recently, we've also seen the TCS also being, brought into force. For taxpayers, non-compliance with TDS has implications of interest and penalties, but also results in disallowances of expenses, which means that this implications for taxpayers is much more significant. TDS is also an area where we see frequent changes which happen in the budgets which are presented by the finance ministers year on year. 2023 also has seen some significant changes. Some of them are welcome. For example, the TDS, which is now applicable on salary income, is fairly straightforward. At least there is clarity that the TDS will now have to be done under the new tax regime unless the employee chooses otherwise, which I think is a welcome move, because for all employers, now there is clarity in the way in which TDS needs to be applied on salary income. Having said that, I think one of the issues that a lot of taxpayers have had comments on is on the increase in the TDS on royalties, which has gone up from 10% to 20% when payments are being made to non-residents. Some of these changes does, in my view, impact the overseas investments into India or transactions which overseas, participants have with Indian companies, and also brings in some level of uncertainty, if I can say, as far as the Indian tax regime is concerned. Um, our suggestion is, as we move forward, like Shekhar mentioned, with the new tax regime, coming in, it really would be helpful if the tax TDS, sections are simplified as we move forward. I'm hoping that some of these issues will come up for discussion in today's session. I hope that today's session is going to be engaging, interactive, and brings clarity to some of the issues being faced by the SSEs and addresses some of the concerns and challenges. I'm also hoping that this forum also helps the department to get a better understanding of the issues and challenges faced by the SSEs, and together we are able to find solutions as we move forward. I'd like to request participants not to ask any questions which are specific to your own assessments. It is now my pleasure and honor to invite Ms. Preeti Garg, Chief Commissioner of Income Tax, TDS, to give her keynote address. Ms. Garg belongs to the 1989 batch of Indian Revenue Service. She, in her mid-tier career training, has been to IIM Bangalore and Maxwell School of Public Policy, Syracuse, USA. She's worked in various capacities in Northwestern region, Karnataka, Andhra Pradesh, Telangana state. She has worked as CIT-DR, CIT Appeals at Bangalore, Principal CIT Central, Visakhapatnam, Hyderabad, and Bangalore. It is indeed our privilege and pleasure to have Ms. Preeti Garg to provide us with her keynote address. Over to you, madam.
Thank you, Mr. Sunil, and a very good morning to all the participants for this seminar on TDS today, organized by BCIC. As you all are aware and have highlighted, TDS, that is tax deduction at source, forms an important source of revenue for the central government. In recent years, as we have watched, there has been an all-round increase in TDS collection, particularly in the states of Karnataka and Goa, where TDS collection forms more than half the share of the direct tax collection. This year, we have crossed the 1 lakh crore mark and have collected over 1.25 lakh crore of TDS in this region. This has been possible by the active cooperation of all the tax deductors who have helped the central government collect nearly 9 lakh crore of TDS in this financial year 22-23. And if I may add, least intervention from the TDS department. Tax collection by TDS is a convenient way of collecting tax at source, as the recipient has to part with only a limited part of his income at periodic intervals instead of having to pay a large sum at the end of the financial year. It is also a convenient source of tax collection for the central government, which receives regular remittances every month, as the same is needed for running the business of the government. TDS also helps in providing source of information about the taxpayers who may not have otherwise filed their returns of income. Since TDS is being made on their payments, they are brought into the tax net. It is therefore a win-win situation for all concerned. I am happy to be here at this webinar being organized by BCIC Bangalore today. It is heartening to see that so many of you have joined here to update and share your knowledge of TDS provisions. There have been many amendments in TDS provisions in the recent years, expanding the source of TDS and TCS both. I am aware that there is a need to fully understand the implications of these changes in day-to-day operations. With the increased foreign investment and cross-border transactions, there are many withholding issues which may need to be finely explained. I see from the panel of speakers that many experts are here who will be able to guide us all. There are many operational issues of transfer of credits across entities in merger and acquisition cases for which guidelines have been issued, but we will be happy to take up further concerns to the concerned authorities. In my view, for the entire TDS system to function seamlessly, all the stakeholders have to play their role in an organized manner. Both the tax deductor and the deductees have a responsibility in ensuring correct deduction and timely remittance, and also uploading of the credits to receive the TDS credits promptly. I hope that the discussions in the webinar will help in expanding our understanding of the law and procedures. In recent years, our technology-enabled CPC TDS Ghaziabad, or Traces as it is better known, has helped in filing and processing of quarterly TDS returns. Online application and issue of lower tax deduction certificates has improved taxpayer services, as Mr. Sekar mentioned. Our teams in TDS offices across Karnataka and Goa will be happy to assist you to take up any issues with them. I am sure that the learning imparted in this webinar will help the tax deductors perform their duties more effectively and efficiently. I compliment the BCIC direct team, particularly Mr. Sekar and Madam Tapti and Mr. Sriram, aegis, for organizing this seminar today. I wish you all the best. Thank you very much for this opportunity.
Thank you, Madam, for your keynote address, and especially thank you for appreciating the taxpayers for the compliances and for the payment of TDS that all the taxpayers in this region have done, and really appreciate your being open in terms of listening to our issues and looking to work together in terms of addressing the challenges that we may have. Thank you, Madam, once again for gracing this session and providing your valuable inputs. Thank you, Madam. Rupa, over to you.
Thank you, Mr. Sunil. Now we will initiate the panel discussions on issues and challenges in international tax. The panel members comprise Shri Ravindra Sai, who is the Chief Commissioner of Income Tax. Welcome you, sir, and thank you very much for accepting our invitation to be in the session, sir. Ms. Nithya Srinivas, Tax Head, Wipro GE Healthcare India and South Asia. Mr. Hardik Lakhani, Group Direct Tax Head, India Landmark Group. Mr. Sriram Ranganathan, who is the Co-Chair, Direct Taxes Expert Committee, BCIC, and Vice President and Global Tax Head at Wipro. The session is moderated by Mr. Sriram Ranganathan. Over to you now, sir.
Yeah, thanks, Rupa. Good morning and welcome you all to the first panel discussion for the day. Mr. Padam had some last minute commitments, so Mr. Padam Kincha may not be able to join this session. So the way we are planning this session is I'll quickly introduce my panel members and I will take about a few minutes to explain the critical changes or, on the international TDS that have come up in the last 1 year. Then we can quickly get into the panel discussion with the panel members. Moving on to the introduction, I have an extremely happy to have the company of Mr. Ravindra Sai, IRS, Chief Commissioner of Income Tax International South Zone. Mr. Ravindra Sai sir has started his career with Indian Petrochemicals as a management trainee engineering before joining the IRS. I mean, I'm sure he doesn't need an introduction. Most of us in this call have interacted with him at some point or other. Sir has also completed his LLB from Osmania University in 2017. Mr. Ravindra Sai sir has worked in various posts at Vijayawada, Guntur, Vizag, Hyderabad, Bangalore, and Trichy. He's also undergone training in public administration as IIM Bangalore and in investigation at University of Maryland, Washington, USA. He was on deputation as secretary in AP Electricity Regulation Commission and also Director Tariff Hyderabad between 2009 and 2011. He subsequently worked as a Commissioner of Income Tax Administration for the region of Andhra and Telangana up to 2017, and from from now, like I said, he is the Chief Commissioner of International Taxation South Zone. Welcome to you, sir, and thanks a lot for agreeing to be part of this panel and throwing some light and addressing some of the issues that the taxpayers have. I also have in panel Ms. Nithya Srinivasan. Nithya heads the tax for Wipro GE Healthcare India and South Asia. Nithya has close to 2 decades of experience in handling tax and regulatory matters, and before joining Wipro GE, she was part of EY, PwC, and SABIC. And we have Mr. Hardik Lakhani, Group Direct Tax Head, India Landmark Group, as part of the panel. Mr. Hardik is a chartered accountant by qualification. His expertise includes corporate tax, international tax, equity research, and strategic planning. I'll thank all the panel members for accepting this invitation and being part of this panel. I'll probably start with a quick uh, few minutes overview on what are the critical things that we have to watch out for that has happened in the last year or so from an international TDS perspective. So as Sunil covered in his opening remarks, the taxation on royalty to non-residents have gone up from 10% to 20% effective 1st April 2023, right? Now, this change would effectively mean even for the existing vendors, international vendors on whom TDS is deducted, compliance with respect to the treaties have to be carried out to avail the treaty benefit rates if the companies have to use the treaty benefits. And what it essentially means is we have to do a lot more compliance to pass on that, to provide that benefit, which includes filing of Form 10F, collection of TRCs from all the vendors, and once we get into the 10F, which forms the basis for now utilizing the treaty benefits, we are going to have certain other potential operational issues, which I will have the panel cover as part of this discussion. And that's probably going to be a single largest change in the international taxation withholding as we step into 23 and 24 financial year. So without taking much time, I'll quickly have the have my panel address some of these issues. So coming to you first, Nithya, right now, there's been quite a lot of changes with respect to Form 10F to be filed electronically. The Form 10F forms the basis of TRC, but then if the TRC is required, we still need to file Form 20F. There are quite a lot of issues, I would say, clarification that the taxpayers may need from the for compliance of Form 10F. If you can throw some light on it.
Sure, Sriram, happy to. I think maybe just to take one step back as to the requirement, where did the requirement of the Form 10F emerge? It emerged with the requirement of a taxpayer submitting a tax residency certificate as a precursor to claiming any tax treaty benefit. And that is, I would say, a very legitimate requirement because it is in the interests of the sovereign, which in this country, India, to ensure that the treaty benefit is taken only by legitimate and companies are actually resident of another country, a genuine tax resident. And what better way to evidence that genuineness except for the TRC? Now, a practical challenge arose at the time of submission of the tax residency certificate, which was that often the tax residency certificate did not carry the requirement which we as a country needed in order to be able to grant that tax treaty relief. It was in this background that the Form 10F, the need for the Form 10F arose. And that is why our government specified that when the TRC does not contain certain specific requirements, for instance, the tax identification number, foreign company address, the period for which the residency is being sought, then the taxpayer may submit this Form 10F and supplement the data which is there in the TRC. So the genuineness and the well-intentioned nature of the 10F was very evident. The practical challenge arose, I think, Sriram, as you correctly pointed out, in the execution, because one now with a recent amendment, the 10F has been made mandatorily to be filed online. Now, again, one cannot find fault with the genuineness of the intent. We are moving to an era of digitalization, and there is a sort of a need to ensure that this critical document is also available online. But there have been situations where we are seeing practically, for instance, a digital signature, which is a mandatory requirement in order to obtain, in order to obtain a digital signature and then use that digital signature to file the Form 10F. I am seeing in my own situation, a case where because this person is sitting overseas and has to do the video recording in order to obtain the digital signature, thanks to the security restrictions which are placed as a sort of function of his security in his country, that practical procedure for being able to obtain the DSE is not being able to be completed, and therefore the Form 10F cannot be. This is but one of the many such practical challenges which we are observing taxpayers facing in filing the Form 10F online. Now, with this background, I will maybe just pose two questions for our esteemed departmental representatives in this panel. And one question is one, whether this Form 10F need be made available in a situation where the TRC already gives all the information which is mandated and required by the law. Our understanding as tax professionals is that the 10F is not required, but we would very much welcome the insight and the guidance of our esteemed departmental representatives here to confirm this and bring the relevant clarity to our tax colleagues. And the second question is on the timing of the 10F, whether it is at the close of the financial year prior to filing the return. Should we wait for communication from CPC Bengaluru and then file? What is the appropriate time for this 10F to be filed? These are the two questions, Sriram, I would like to pose to our esteemed departmental representatives. Sriram, should we?
So, yeah, Ravindra, so I said, would you want to give your views on these matters as we go, or would you prefer to give it at the end, sir?
Sriram, let me just check with him.
Sure.
Yeah. Sriram, maybe we can pick this up as we, at the end of it, and we can move on. I think Srinivas sir has dropped out is what I'm seeing on the screen. Ravindra sir has dropped out. I think it's just dropped out. He's there. So you're on mute.
That this matter
So you're
is
on mute.
international
Yeah, we can hear you.
I'm here, but this matter is about international taxation. I'm here. So Ravindra Sai sir would be addressing it. I'll be addressing for domestic TDS.
So let's kind of carry on, and then I'm checking with Ravindra Sai sir in the meantime.
Sure.
Okay. I'll move on, and then maybe just one additional question, which was very correctly, I would say, legitimately raised by my colleague Hardik, and just including that also, please, for consideration and consultation from Ravindra Sai sir, which is that now there is a recent amendment that the Form 10F, like I said, has to be filed online, but there is an extension for people who don't have PAN, and they have been given time till 30th September to file the Form 10F. It, to our mind, is a temporary relief, because at the end of the day, these taxpayers will still anyway need the PAN to be able to file their income tax return as a precursor to claiming the tax treaty relief. I think the question really is whether this relief would in substance bring any recourse, any relief to the foreign taxpayers. I'll pause here, Hardik, if you have any further comment on this very valid point that you had raised. Otherwise, we'll move to the next point.
Thanks. Right. So because the main concern is it is not a CBDT circular, but a notification. And the notification, language of the notification says it does not have PAN or not required to have PAN. And there again, the question arises, any foreign vendor or service provider or anybody receiving a remittance would be required to file a return in India to obtain treaty benefits, and therefore required to have PAN. And that is where it gets into a loop.
Sriram, Ravindra Sai sir is on the call.
Yeah, hi, sir. So there are a few questions that have come up so far. I mean, if I can put those questions to you, if we can have your views on that, sir.
So can you hear us? I think you're on mute, sir. Rupa, could you check if Ravindra Sai sir has been muted from the background? So you're on mute, sir.
Can you just repeat the question?
Yes, sir. We'll Nithya, you want to go ahead with your questions?
Yes, sir. Sir, we were wanting to check with you on a couple of things regarding the issuance of Form 10F. Now, it is our understanding, sir, that the 10F need not be filed in a situation where the tax residency certificate provides all the information which is required to be furnished per law, and therefore the 10F, which is basically a supplement to give information which is missing in the TRC, its requirement does not arise. We wanted to confirm with you, sir, once if our understanding is correct. Was I audible, Tapti?
Yes, you are, Nithya. We heard you. There's a message from Ravindra Sai sir that his speaker button has been deactivated. Rupa, can you see what's the problem? Sure, Tapti. But we have not muted him. Maybe he just needs to log out once and then log in again. He is in the presenter only. Okay, because we heard him in between. Yeah, okay. He says he will exit and log in again. Maybe we give him a minute, Sriram. Otherwise, we have to repeat the questions again.
Sure.
So are you in?
My suggestion is that keep going. Moment Ravindra sir joins, we can ask him to address all the issues. Keep going.
Okay.
Sure, we'll keep going.
Keep going.
So
let Sriram interact with the panelists, and then once he joins, probably note down the issues and then put it to him.
Yeah, sure.
I see Ravindra sir unmuting. So maybe sir, if you can hear us. Okay. So we'll probably move on with the panel discussion as we are able to fix Mr. Ravindra Sai's line. So no, Hardik, this question is to you and then Nithya for you to fill in. See, in the recent budget, we have seen the rates on royalty to non-resident increased from 10% to 20%, right? So what do you think is the implication of this in the to the industry?
Okay. No, of course, standard implications aside, I think the main objective that the revenue or the government had in mind was was to avoid loss of foreign exchange is what I thought, because it was not just 10 to 20% on royalty FTIs. There was TDS on foreign travels, various TCSs. Any foreign remittances are now getting more stringent. So my only request is, if this is an attempt to save foreign exchange, doing it through tax has a lot more other implications on the economy and the business than just saving foreign exchange. We could probably do it some other way, but directly, of course, the impact is that is a hit to the ease of doing business. We have difficulty getting top-notch quality of technology into the country, because that suddenly is more expensive. Standard remittances is a different thing, but payment for royalty, payment for technologies, especially from high tech advanced countries, which is the need of the hour. So that is a very valid concern as to how easy or how cost effective will it be to obtain such services going forward. So we don't want to start lagging on technology just because it is suddenly a lot more expensive from a cost perspective. That I hope is not where we are headed to.
Nithya, do you have any inputs on this point?
That's a valid point, Sriram. I think we have to understand that commercially, most of these contracts are net of tax contracts. So basically, the foreign company will protect its interests by insisting that the Indian company bear the taxes on such payments. And usually, these payments are for use of technology, which is not yet available within the country. Now, what happens when you have net of tax contracts, as Hardik correctly put, is that the burden is effectively passed on to the Indian company. So, what was costing very simplistically 100 rupees earlier, and let's say it was grossed up by 10, so I'm just putting the math aside for a minute, it was effectively 110, now became 120. Now, this could possibly have two, repercussions. One, again, as Hardik pointed out, it increases the cost of doing business in India, which does seem to be a bit, I would say, contrary to our objective, our country's objective of Make in India and inviting foreign companies to work in India. Specifically, cost arbitrage is used as a very strong point as to why business must be done in India. But a move like this could potentially increase the costs, which seems, again, like I said, contrary to the overall intention. Two, when we look at where our country is heading in terms of wanting to address the dollar's supremacy in international trade, I was reading some time back about how we are looking to settle our payments with 16 countries in INR. This does somewhere contribute to an excessive outflow of dollar and our own, I would say, payments in foreign currency increasing. So like I said, instead of paying 100, we are paying 120. And that puts further stress on the currency. And given that some of these payments are made to our counterparts in the US, there is a tendency to further support the strengthening of the dollar against rupee. It is with these mindsets that perhaps this position could be reconsidered, because whether it does indeed bring in the benefit that is desired, or does it maybe have our attending consequences which are not entirely pleasant for the Indian economy, is something that would be worth to consider.
Sure. Thanks, Hardik, and thanks, Nithya, for your views. So, Ravindra Sizer, if you're fine, there are three questions that have come up so far, and if you can have your views on that before we proceed on the session.
Yeah, you can go ahead.
Yeah, thank you, sir. Sir, there are two questions on Form 10F. First one being that our understanding is that Form 10F is required to be filed in case the TRC does not provide the information that is mandatory for providing the relief under the treaty. And wherever the TRC itself is comprehensive, is it the right conclusion that in those cases 10F need not be filed, sir?
See, I have two views on this. One, if you really look at the provision in the rule book, it says may not be. It doesn't say if TRC gives everything, then Form 10F is not necessary, is not the word used. It may not be required, it says. And secondly, the philosophy for having Form 10F is TRC issued by, let us say, approximately some 100 countries odd or even 20, 30 economic countries with which we have most of the dealings. The format and everything differs from country to country. So that is one of the reasons why Form 10F was introduced as a way of standardizing the inflow of information into the system, in which whatever details given by TRC in different formats by different countries may not be capturing all the data. That was the reason. But suppose your 10F, your TRC issued by a particular country, say, captures all the details. Even then, in the age of computerization, my personal belief is, see, here I would like to take you a bit into how the computerization works. When they are specifying what are the required, when you are filing a return and are claiming a tax credit and you are attaching TRC document, in fact, there was also one question as to at what point we should be sending it, should we be sending it later or not. So basically, whenever you are making a claim for DTA relief, you should be sending TRC. And suppose it is along with your return, and in this CPC processing, in the system, when they run through the flowchart, suppose Form 10F is one of the requirements built in the system. It won't process further, or in most of the cases, it doesn't give relief. So my advice is, rather than take a chance that I am meeting the legal requirement in that my TRC captures all the details and therefore I may not be required and I need not file. If you have TRC, you can as well complete Form 10F and file. That would save you further trouble down the line. Because see, the computer process flow is always like a checklist comparing what are the documents needed and what is given and what is not given. Suppose there, if it is only by trial and error or by actual implementation, we can really see whether if Form 10F is not accompanying, the system is rejecting it or it is accepting it. But this point I can highlight and take it further. But my personal thing is, if you want to get things done fast, once you have TRC details, if the same details are to be put in Form 10F, which I have seen also, it is not much different. You can as well put it and be done with it rather than take a chance. That is the way I look at it. Because ultimately, when it is processed in the system, you never know how the system programming flowchart is made, that even I won't know for that matter. And if documentation cross-checking or cross-verification or requirement is one of the things, it may not even process or it may not give you credit, which doesn't serve your purpose. So that is my view. I hope I am
Thank you,
clear.
sir.
Yeah, I can tell you very nicely, it is not needed, but you will be the person in problem tomorrow if you don't get credit.
No, absolutely, sir. I think your point is well appreciated. And also, I think, like you said, it will be useful if we can further take it up. I mean, we can also send a joint at the end of the call. We can accumulate all the points which, for your consideration, will add this as well. Whether this can be eased from a system flow as well. If today it's there in the system flow, the 10F is required, even if TRC has all the information. We will do that, sir. But your views are very clear, sir. We completely appreciate where you're coming from. Yeah.
See, I understood what you are saying, but when I also look at the requirement of making it online application from March 23 or April 23 onwards, I see a system integration coming en route. And whenever system integration takes place, it will always cross-check what is lying with them and what is not lying with them. So this I will point out, but until you actually cross the bridge, you will never know. So until one return is filed and it is accepted or rejected, I will never know how the process flow was built in, but I will definitely mention it so that they take care of if they can tweak it at any stage.
Thank you, sir. Thank you. But your views are very clear, and we appreciate we appreciate the clarity, sir. You're absolutely clear on what is the best way to deal with it till we get further clarity on this. The second related question is on timing, sir. The timing is when do we expect to file it? At the time of filing the return, or at the time, or do we wait for intimation to sort of file this Form 10F?
No, don't wait for intimation. Means actually it is processed, no? So basically, when you are claiming a double taxation avoidance agreement relief and you want to reduce your tax burden, or you have paid self-assessment tax accordingly, taking DTA relief into account, you should file along with the return to substantiate why you reduced. Otherwise, the system will simply calculate according to its own, not give you DTA credit and raise a demand.
Yep. Yes. Yep.
Whenever
Sure,
you
sir.
are making a DTA claim, the claim should be accompanied by the documents prescribed.
Sure. So, there were a couple of operational issues which are highlighted by Nithya as part of this whole process. And maybe Nithya, if you can just highlight some of them, we may not have answers for that, sir, but at least just want to highlight some issues which are faced by us, so that it can be sort of considered whenever this whole process is sort of relooked at, sir, from a taxpayer perspective. Nithya.
Sir, I think the biggest operational challenge that we are facing is now, as we move online, as you rightly put, now that the system enhancements that you foresee are coming, and as a precursor to that, the 10F is being made to be filed online. There are some requirements for the 10F to be filed online. For instance, the requirement of a digital signature. And we are observing that a lot of times the kind of security firewalls that exist amongst multinational companies, procedural aspects, for instance, you need to do a video call, to get a digital signature. Those kind of requirements do tend to get in the way of obtaining DSC and therefore filing the Form 10F. I guess a simpler way, and that was the proposal, sir, if for your kind consideration, is if we can still, have an approach where perhaps the 10F is issued physically by the foreign company, but the Indian company which is claiming the treaty relief can, file the details of the 10F in the TDS return. That way, the government's objective of ensuring that the information is received electronically is achieved. At the same time, the requirement of the foreign company to go through the various processes involved in digitalizing the Form 10F can be reduced to some extent.
No, there are two aspects in your question which I would like to first understand. Before that, see, a digital signature is any signature on a document basically authenticates to establish the ownership and liability of the person issuing the certificate. So that is the purpose of any signature, particularly in any legal document like either ITR or any form submitted to department. Digital signature is only simplification in which you do away with manual signing when you are filing online. Now, when you take it to the next stage where even the document is being filed by some other company on their behalf and all, I'm really not sure how it works. And the second aspect is when you talk of the Indian company enclosing along with TDS return some 10F, you are taking me into deeper waters, which I'm really not sure where and how it fits in. Because the Indian company filing a TDS return is regarding what? Is it under some specific section? Is it because basically 10F is linked to tax residency certificate linked to DTA claim. Apart from that, I don't see any other scope for that particular form. And when you are trying to link it to some other TDS annual returns or something, it is beyond, I think, see, income tax looks at each provision, each claim of exemption or deduction in a specific context with a specific requirement of documentation. This multi-layering or fusing up of forms, etc., will become very difficult because tomorrow you yourself cannot separate it, particularly when a company has a huge TDS annual return to submit. So when you talk of combining this with annual return and submission by a domestic company, frankly, I haven't understood what actually you meant. Therefore, my reply may not be suiting or it may be tangential. But looking at the processes, I always feel whenever there is any claim and a specific bound procedure for it, better stick to that rather than combining it for the ease of reference. See, it is like one very joking principle they say, na, it takes more time to do a thing quickly. In the guise of doing a thing in a simpler way, we should not end up complicating it further.
It's a fair point, sir. I guess to your point, your perspective where you're visualizing income tax and TDS maybe, into different compartments versus a taxpayer's perspective, and particularly an Indian company where we are looking at it more from the withholding tax angle. So very fair point, sir. Well taken.
Thank you, sir. So the next point we were just deliberating was on the TDS rates on royalty to non-residents has increased from 10% to 20% in the Finance Act, right? So there were a few potential issues that we are seeing on the ground, sir, with this increase from 10 to 20%, as a lot of contracts are net of tax contracts, and essentially it would mean that instead of 10%, the Indian company ends up grossing it by 20% instead of 10%, and the foreign entity continues to earn the same amount of money because the contracts are net of tax. So where there is a feeling that this would increase the cost of doing business for the Indian companies, this rate increase from 10 to 20. Just wanted to understand from your perspective the intent behind this change in the rates, sir.
See, we only implement, and if the rate is changed, maybe the memorandum to the finance bill would explain why it was done. And if it doesn't explain, I will try to accept it. Any changes
Sure.
in the Finance Act, they explain in that memorandum. If anything is spelled out there, usually they do. And I am told almost some 40-50 further amendments have come. So I don't know whether this has been again relaxed or further. I could not update myself on the amendments made recently before the bill was passed. So you
Sure.
can just have a look there, and if it doesn't spell out, maybe we can put and try to find out. But as on date, I don't have any information as to the why behind it. And
Sure.
regarding operational difficulties when you do net of tax calculation and all, I'm sorry, I won't be able to give any insight or input on that at this stage, because the computations and all depends on company to company and how they structure their deal. So maybe it will differ in each case and how it would affect. But the actual rate which is prescribed and why it was enhanced and all, I am not very sure as to the reasons, because like I said earlier, only the memorandum can spell it out.
Sure. Sir, I think the memorandum did not explain why the rate changed from 10 to 20%. The only point we wanted to place is that this would mean increase in cost of doing operations for the Indian companies, because like Nithya was mentioning, it was sort of
No, no,
most of the
I
contracts.
understood.
Yeah. Okay.
I mean, I understood that part, even her apprehension that it will only increase dollar outflow and all. That is all fine. But actually, when in the implementation, I am really not sure why it was made or how the working
Sure.
has to be done.
Sure. Sure.
So when
Sure,
I
sir.
am not sure, there is no point in commenting on things which with half baked.
Absolutely, sir. Point well taken. Sir, I think these were the questions so far, sir, that we had from the panelists, and I think your answers are pretty clear, where as to how we need to look at all of them, considering the fact that we want things to close and move smoothly, and as some of these things emerge, maybe we will get more clarity. I think that's the point well made, sir. Thank you for that. We just moving on the discussion. Nithya, I think there were a few decisions that have come on cross charges, paid out by the Indian companies to the aegis on secondment of employees. It will be good if you can elaborate, these decisions as to what they mean, and what are the clarifications that we have. Then we can have Ravindra Sai's view on them as well.
Sure, Sriram. I think the issue is at its heart that of secondment, or as in India is more known as deputation of employees. Now, while it may differ in fact pattern wise from company to company. Broadly, what we have seen is that you will have a foreign company deputing certain individuals to the Indian entity, while the employee will have a local contract, that is an agreement with the local entity, and for documentational purposes it will appear that the Indian entity is the one which is both the legal and the economic employer of that employee. More often than not, it is seen that these employees retain a lien on employment uh, with their foreign company, in that after the period of deputation they do go back and resume either their erstwhile role or another role as maybe determined by the foreign company. It is also seen that while during the tenure of the deputation, the employees are expected to work under the control and supervision of the Indian employer. Their social security continues to be paid in the foreign country, and from an administrative or procedural perspective, what happens is that the Indian company ends up reimbursing the salary cost back to its foreign associated enterprise. Now, on this uh, reimbursement, the position which most Indian companies have taken is that there should be no withholding tax, in that it is not a service contract. I am merely reimbursing the salary costs which I am incurring on behalf or while paying to my employer. Now, here I think there have been some, you could say, questions that have arisen at the time of processing of the withholding tax applications, because we've seen in the past that there have been a couple of cases where taxpayers have approached the department and requested for nil withholding tax orders on the premise that this is not, as I said, a contract for service, but rather a contract for employee secondment. And we have seen that the department has been more akin to taking them as service contracts, saying that this is a situation where services are being rendered by the foreign company, and therefore withholding tax must be applied. Um, just wanted to bring in this panel and sir's thoughts on this position, because then we have sort of divergent views. Karnataka High Court has in a couple of cases said that this is a contract or should be treated as a contract for reimbursement, and even if we were to consider it as a contract for services, then there must be a treaty relief which must be explored, whether there is make available or not under the treaty, and if yes, then a case for no taxability still remains. And then, of course, there is the Supreme Court ruling, which came last year in the case of Northern Trust, which was, of course, on service tax, but also had a very interesting kind of a viewpoint on applicability of service tax in case of manpower supply services such as. So this is the context, and the area where perhaps, sir, your thoughts, and Sriram, please, if you or the rest of the panel also have some inputs in terms of what should be the appropriate position that the taxpayers must take.
Sriram, you can fill in, then I can talk.
Sure. No, sir. The question basically is, should it be considered as a service contract subject to TDS, or should it be considered as a reimbursement contract and not subject to TDS? We wanted to have your views on that, sir.
Okay, see, again, rather than touch this specifically, I would first like to see actually why any TDS or anything is made, or what is the basic rationale behind it. Now, you see, what happens is when you, let us say, TDS basically tracks the payments made. That is the first philosophy. And second philosophy is, if the payment is in the nature of an income, somewhere there should be a tax on that income and somebody should be footing the bill. It stems out of that. If I don't have TDS, I won't even know who earned what or where the funds are going and what for it is going. That is the first part. Second part of it is, particularly with reference to non-residents or NRIs, once the money has flown out, there is no way in which you can get back because it has flown out forever. That is why the TDS rules, particularly for NRIs, are more stringent. And it is always like first you deduct and claim later. That is the general approach as far as NRI things are concerned. Now, coming to this particular thing, there are two issues involved. Now, let us say Mr. X has come from US and is working in India on behalf of, say, Amazon or Apple or something, and the Indian subsidiary pays to Amazon and claims it as a reimbursement. That is where the issue is starting. Now, what happens is the person who is receiving salary in India, there are now factual questions come. Is he receiving salary directly from US? Is the money being credited to his account in US by Apple US or whatever is the MNC there, as in our example? Or is it the Indian company which pays him first and is in turn reimbursed by the foreign company? How does it actually work out? We have to see. And this, when I'm talking of one person, let us say for a big project, some 100 or 300 people are deputed of various ranks, including supervisory and all, and the total wage bill runs to say 1 lakh or 2 lakh dollars, which you are claiming as a reimbursement. Now, the main interest for the government or from the tax perspective would be what you claim as reimbursement is actually someone's income, and that income is of the technician working in India. So where is he being taxed or is he being not taxed at all? How do I keep track of it? That is the way I have to understand the question. It is not a case of Indian company remitting some payment to foreign company and paying. I am only reimbursing his expenses. What is your problem? Problem is not the earning of the foreign company or the earning of the Indian company, but the problem is the wages earned in India for services rendered in India are technically taxable on source basis in India. But for these 10 technicians, how do I determine the tax liability, or how do I even come to know of it if I don't even do any TDS and let the entire reimbursement, let the entire foreign exchange go out, or payment be made on the basis of reimbursement of expense and no TDS? That is the fundamental part. So when a person asks for withholding certificate, or when he says you allow me at nil, and suppose he gives details of 100 employees, how that, let us say the total amount of $2 lakh, how it is worked out, it actually pares you down to each individual who is earning in India and on whom the tax liability finally rests. So how do we fix that? If we have clarity on that aspect, the other issue of whether to facilitate you to remit or without any withholding tax becomes secondary to me. And whenever there are conflicting views, be assured that the department will not rest till the matter travels to Supreme Court, because amounts involved in a year will be huge.
Yeah.
So just because one, yeah, you can fill in.
So I just wanted to add, typically in all of these cases, the 100 individuals that you spoke about based on the source rule, there is tax withholding that happens under salary, and there is a Form 16 that is issued. Typically, that is the fact pattern, sir. And
sorry to interrupt you, Mrs. Tapte. See, the question is who is doing TDS and at what level? Let us say, so if the Indian company is doing TDS and paying him the salary here, then how exactly it is reimbursing? The question of this reimbursing the foreign company doesn't arise. The foreign company should be paying him. No? See, you talk of no. Let me, or maybe my understanding is not correct. The way I look at any reimbursement means, basically reimbursement, Mr. X has incurred the expenditure first and then Mr. Y pays him back. So when you say the Indian company is reimbursing the foreign company, the first understanding is that the foreign company had paid that person's salary in his own country, and it is part of his salary income in that particular country on which withholding tax according to that country's laws is done. And then it says that the person deputed to India is paid by me at the rate of 5,000, but since he is rendering services to you, you reimburse me this $5,000. That would be the claim, as I understand, when you say reimbursement of salary expense on a person sent to deputed to India. But if if the foreign company is no way involved, it just sends 10 people to India and they continue to draw their US salary, as I would now treat it as something like a retainer fee for remaining in that company, and this is the additional income which they are generating in India and which they are being paid for services rendered by them in India. And if it is the Indian company which is doing TDS, then what is the Indian company reimbursing the foreign company then? Then it is only paying them a fee to obtain the services of the person apart from the salary paid to the technical person. So the fee which they are paying to obtain his services, now there are two components. I also pay salary of $5,000 or something, say, to Mr. X for working in India, and I pay in Indian rupees and do TDS. And I also pay the company for making me available the services of that person. So then it will not fall in the form of reimbursement of salary at all. It will then be an additional payment which is being made for enabling that company to render services of their personnel in India. So there is a distinction when you talk of reimbursement and what actually you are reimbursing. I think in the two examples which I told, I have been able to make it clear to you. Is it okay? Or are the situations differ?
The situations would generally differ, sir, because the salary, yes, is paid in the overseas location because Social Security in most cases would need to be continued as per the request of the individuals. But they are working under the employment of the Indian entity, and hence all of that cost that is incurred by the overseas entity is cross-charged to India, and then a remittance is made out. On that entire salary paid in India, paid overseas, the Indian company takes on the obligation for tax withholding, and tax withholding is done in the normal course. So the facts are actually somewhat different from the scenarios that you spoke about, sir. This is a case where these are typically cases where the entire salary is passed on to the Indian entity because they are the employers. The only reason why the payment is made overseas is because their social security made as per the request of the individuals.
No, what is being paid overseas? Only the social security charges.
Yeah.
Social security charges, the salary itself also into as credit into their overseas bank accounts. Generally,
No, okay.
Let
us get into examples as we understand. Let us say my basic salary is 1 lakh. My PF contribution is say 10,000 rupees, and let us say my medical insurance claim is another 5,000. So from what you have spoken, I understand is the foreign company pays 15,000 abroad to retain there, but the 1 lakh is paid by the Indian company in India. Is it the way you are interpreting or communicating?
The 1 lakh may be paid in the US as well, and then that is cross-charged to the Indian company along with any social security costs or any medical costs that may be in the first place incurred overseas and then passed on here. But yes, the facts may change case by case. Nithya, you want to add?
No. I see. This is what I said is the first interpretation when you talked of reimbursement. The entire salary is paid abroad. But when you say it is the Indian company which pays and even issues Form 16, I am getting confused. So who is at what is it that they are issuing Form 16 for then?
For whatever is paid overseas as well as whatever is paid in India. On the entire salary, the Indian company takes on the obligation for tax withholding and the cost, which is why they are reimbursing the cost.
Okay, so to continue my example further, so let us say my 1,15,000 which I was receiving abroad, and India also, let us say I receive another 1 lakh. Then on 2,15,000, the Indian company issues Form 16 and does TDS.
That's right, sir.
Yes.
Okay, if it does TDS deduction in India on 2,15,000, and then it is remitting only 1 lakh, then where is the question of reimbursement comes? It is like remitting the money on which already TDS was done. Na?
Exactly.
So then why the issue will come? Maybe maybe I am not then grasping the point as to how you are documenting it, which is creating confusion. Because you see, a payment on which tax has already been deducted in India and paid, if it is being remitted, it should not normally attract further TDS. But
That's
if it
right.
is attracting further TDS means the nomenclature is such that, or your classification of expenditure is such that it is not getting reflected that this amount was already subjected to TDS in India. Maybe with actual example or with actual working sheet, if some of you can send it around, I can see, or I'll go through the case laws cited like Google and Flipkart and again take a relook. But
Sure.
at this stage, for me to comment beyond would be assuming too many things, and particularly on an issue which had already traveled up to different courts.
Sure, sir. These are the
Sure.
two
But
most
my first personal reaction is on an amount which was already subjected to TDS in India, which when you are remitting abroad, you have to show that this has already suffered tax in India. It should not suffer further tax unless the classification or nomenclature is differing, which I don't know how it was actually worded or how it can be explained when asked. I hope I
Sure.
am clear.
Yes,
No,
sir.
no, absolutely, sir. Absolutely. In fact, I think the only point which I will add to what Tapti and Nithya said, see what happens in some of the situations, sir, while the TDS is happened on entire global income, the Indian company will not have the registrations in the foreign company, which is, let's say, in the scenario, parent company to from who has seconded the employees, and hence the actual remittance of social security will be carried out by the foreign entity and not the Indian entity. Though, and hence, since the services are to an Indian entity, they recharge it from the Indian entities. That's the only point I wanted to add.
Okay.
So, but this is clear, sir. We will share those couple of examples to and take your guidance on how do we sort of sort it out, or is there any how do we take care on the document? Because I think the point is very clear, very clear. So 192, we have done a withholding under 192 and complied with, including what has been paid in the foreign company. But when the foreign company charges the Indian company, again, sort of payment triggers one more TDS is a worry.
Okay.
Can
Sure.
continue.
Moving on, sir. The other aspect is with lot of foreign companies setting up operations in India. One of the things that we see commonly is that the Indian employees of Indian companies have stocks from the parent entity, and there are different strike prices, and the consideration is actually paid by the foreign company, and this has created sort of certain clarifications which we seek for. I'll request Hardik, if you can take up this point, explain the scenarios, and then what are the clarifications that will be useful for us. Over to you, Hardik.
Thanks. Thanks, Sriram. So, sir, actually, because the provision on TCS for LRS is a new provision, and that is why these concerns come in. Ordinarily, if these transactions would have been paid under the LRS scheme, they would have been subject to TCS. But instead of LRS, these are now processed by the company under, let's say, the ODI or current account transactions, something of that sort. And the question is, are you supposed to export the intent of the TCS and LRS provisions to remittances under the other scheme? One example which Sriram mentioned was in the case of ESOP. Right. So let's say an employee in India is employed by the Indian entity, which is a part of an overseas group, and the overseas group extends the ESOP scheme to the Indian employees of a subsidiary, right? And the Indian employees have to contribute to the ESOP scheme, or let's say the purchase plan, and let's say they pay 100. In some cases, a portion of that 100, let's say 20, could also be borne by the Indian entity. If a portion is borne by the Indian entity, it's subject to 192 TDS. But for the balance 80, when it is repatriated by the Indian company on to the overseas entity, right? Is that also subject to TCS under the LRS scheme, although it is not going under the LRS scheme?
Okay. See, firstly, LRS is basically a part of FEMA and governed by RBI. And they also have capital as well as current account sort of payments and also I'm not very sure And you yourself are saying that it is not part of LRS. Now, the second part is, so I didn't want to venture into an area which is basically FEMA as well as RBI governed. So whether that particular payment falls under LRS scheme or not is secondary part. But you are also saying that it is not part of that. Then it boils down to basically you remitting. Let us say there are 10 employees in India who got such benefits. So 10 into 80, 800 rupees the company is remitting on their behalf. Whether that 800 should be subjected to TCS is your query, no?
Yes. Because we can foresee a scenario where the assessing officer is going to ask us, I mean, had the company not done it for you, you would have done it under the LRS scheme, and therefore why is TCS is not deducted, why is TCS is not collected? And assuming a TCS has to be collected, should it then be the responsibility of the company, or should it be the responsibility of a bank? Although strictly anything beyond the LRS scheme should not require TCS, but it's difficult to say how things will take shape in the course of assessments. I mean, we're not expecting an answer, sir. We just, these are scenarios we come across.
Yeah, we can.
And we're hoping if you can just take it back.
No, you see.
Then,
safety first approach and ask later. So that is the simpler thing. I'm trying to understand the larger ramifications when you are, basically, it is like this. LRS itself is a very liberal scheme. When you say you are not, I would rather put it this way. Remittances abroad require a lot of scrutiny. To facilitate the ease of business, LRS scheme was introduced that everything need not be looked into or everything need not be subject to so many prior restrictions and approvals. Now, just for the sake of to take out a payment out of LRS purview, you may be falling into a larger pit of problems rather than a simple case of TCS. That is my first reaction. See, I should not make use of an argument that it is not LRS because I don't have to do TDS now or TCS now. To me, looks as a more fraught with danger rather than claiming it as an LRS, because LRS allows you to remit up to 2.5 lakh in a much, by the very definition, it's a liberalized remittance scheme. So I always get stuck when you try to come out of a liberal scheme for avoiding TCS or for not doing TCS. Because TCS or any tax deduction, it's only a question of time and postponement of liability. You always recover it, but you should not fall into a bigger pit. Though I am not sure of FEMA provisions and RBI provisions, I am not venturing out. But don't be in a hurry to come out of LRS scheme just because you want to, I won't put it as avoid, but you want to say I need not do TCS. That should not be the approach to look at LRS. Because then every remittance becomes a questionable thing. Yeah. So first be clear on that as a client as well as an advocate.
Yes, sir. So just to clarify, no, we are not avoiding.
Serious in my opinion. Then the second part is regarding the computation part and all. Yeah, okay.
So I just want to clarify.
No, I understand you are not avoiding. You are trying to seek a, yeah.
No, because the company will have to pay it, and a company is not eligible for the LRS scheme. And since the company has to pay, so it is not a question of avoiding it. It is about how the mechanics work. And a company is not provided with the LRS scheme. And a company will have to pay it on behalf of their employees to the holding company. It is not something that the Indian company is avoiding on account of TCS. It is just how the mechanics work.
See, if the company does TCS and remits only the balance, it will only remit the balance then, na? TCS works in
TCS
that
will
way.
Be additional. TCS will have to be additional. TCS on account of employees will have to be collected additionally and the amount paid off to Holdco.
So that, so continuing your example, say one individual, 80 rupees the company remits, but it also collects, say, at the rate of 10%, 8 rupees from the employee and does TCS. And the employee is asked to claim this 8 rupees as refund later. Is that the way it works if TCS is implemented?
That is right, sir. But 8 rupees would very often be more than the tax liability of the
Hello?
entire of the employee for
No,
3 or maybe 2 years.
I understand. See, I would
Hmm.
first like to know how the mechanics work, then to see how it can be. If my understanding of the mechanics is wrong, then my solution or my attempted solution will also be wrong. That's why I always paraphrase it first, so that I am clear as what is being debated. So this is the issue. Whether 8 rupees
sir.
itself
Yes,
is more, whether it is disproportionate, that is all secondary. But if TCS
that's
is
right.
allowed to be implemented, this is how it will work.
That's right. Yes, sir.
Okay, I'll see, and maybe I can come back to you later.
Sure.
Thank you. Thank you, Hardik. Thank you, sir. So I think we are almost to the hour. We are about 4 minutes left for this session, and we have a TDS session on domestic following this. All right. So maybe in the interest of time, sir, we also have a few operational issues on 15CA, 15CB, which are more operational in nature, which we wanted to highlight it to you as to how it can be resolved, bring it to your attention. So Hardik, if you can pick up those issues, couple of issues around 15CA, CB, and what is the issues that we are seeing on the TRC, so that we are able to explain what issues we are facing.
Thank you. So, sir, these are mostly recommendations, which we hope you could think about it and implement it for the sake of. I mean, we are making these requests on the sake of taxpayers for the ease of doing business. So the first thing is the processing or the uploading of 15 CAs and 15 CBs is very slow and it takes a long time. So if there could be some guidance note or some system improvements to do all of these 15 CS, 15 CB uploads. I just take all the recommendations together, sir, for want of time, and then maybe we can have a comment, sir,
Hardik,
please.
I'll interrupt you for a minute. See, whatever recommendations you are making as a body, can you elaborate in detail and mail it to me later? Because
Yes, sir.
yesterday, some of the, see, like simplification of Form 15 CA filing is a very summary way of putting it. But if you can capture where you are getting stuck or what actually you are looking for, it will be helpful much more. Because when I make any reference to the system also, what happens there is, they always look at where the problem is coming. So let us say when you are uploading, you are facing problem of either memory or problem of length of size of the document, or with respect to any authentication route or any verification route, or if any specific thing is there, if you can spell out in your note, it is fine. Otherwise, the general thing like the system is slow and it should be simplified, I will forward, but it won't cut much ice because they will also not know where actually is the problem is. So those who are filing and those who know actually where the problem is, if you can capture those points as to where the bottlenecks are, it will also help the system people to wriggle out those issues. This is only by way of clarification I am saying, so that when we make any suggestion, they will also know exactly where they are getting stuck. Yeah, you can go ahead.
Yes, so from that aspect, one specific point was like, let's say, for example, a company has to make TDS on dividends, and there is a way to consolidate and make one request for issuing 15 CACBs together for one transaction, which may have 1,000, 500, 250,000 pays, instead of having individual 250, 500,000, 15 CAs, 15 CBs issued. So that was one request. The second thing is Form 3. When making an application under 197, it requires the TAN of the buyer. And let's say if there is no tax liability issued, then the buyer, the other party, will have to take a TAN for no reason, and that requires a lot of complications. So if we could avoid TAN till the stage that there is determination of liability. The third thing is TRC. So I'm just doing it very quickly for want of time.
Yeah.
So
No
TRC.
problem.
Yeah. So the next is TRC, and let's say the beginning of a financial year, let's say for transactions that we make in the beginning of a financial year, the new financial year may not have started for them, or they might have delays in getting TRC. So there is a time gap, and if for that interim period, if we can have the TRC of the earlier period from the non-resident, that would help a lot. And let's say for payment of rent by to a non-resident landlord by employees. So I think this does not require TAN, but we just check this and we come. There is in case of revision of Form 27Q, what happens is we have to make TDA. We'll have to file these TDA statements offline. If there could be a way to make these TDS filings online for revisions of non-resident payments, that would also help. I mean, similar to other domestic remittances.
Yeah, you can send these. Just
Yes.
1 minute before we conclude. Regarding this non-resident sellers or buyers and requisition requirement of having their TAN number and all, this is a recurring issue in many transactions, and as on date, some jugaad thing is going on in which department is even accepting the PAN number quoted. But strictly speaking, yes, if the law says his TAN should be there and it is not there, it is creating a problem. I will highlight this issue. But in practice, jugaad is already going on in some way or other. Maybe if you are not strictly following the word of law, that is being done already. But that is not the way to approach. I admit we will try to bring it to see how it can be done.
Sure. No, thank you so much, sir. I think we are almost up 12 now. Sir, we would collate some of these recommendations along with the issues we face with details and submit it as part of BCIC to you, sir. There are about 7-8 points which we have covered here,
Yeah,
which
you
we
can
will
do
come up
it.
with a detailed
See,
note to you, sir.
feedback is essential. Please do. Feedback is essential for us also to see where things are being perceived as bottleneck. But I also like to say that wherever non-resident payments or remittances are involved, the bottom line always is once the money has flown out, it has gone forever. Refixing or getting it back is very difficult. That's one of the reasons why the provisions are always a bit more stringent rather than a bit more compliance oriented. But within that, whatever is possible, there are always attempts to ease it further, and I will certainly forward them to wherever
Sure.
the actual decisions are taken. Thank you.
Sure, sir. Thank you so much, sir, for taking out your time and being part of this panel. And again, thanks Nithya and thanks Hardik for sparing time for this panel discussion. I know we are run out of time, but if you have 1 or 2 questions from the members who have joined this discussion, we can pick it up here. And please, like Sunil said, please do not bring in any SSC specific. Please bring out issues or bottlenecks that you face, which are generic and which we can get Mr. Ravindra Sai's view and other panel members' view as well. Right.
I think in the interest of time, Sriram.
Yeah, probably in the interest of time, we'll conclude this session. And if you have any questions that we have not covered and you want to ask us, please drop a note to Rupa. We will consolidate it and try to address it. And also any points which you want to include as part of representation from BCIC to the department with respect to international TCS, please drop in a note to Rupa. We'll get it consolidated. Thank you. And Ravindra Sai, thank you so much for taking out your time. And I know you're on travel. It's not easy to pick these calls when you're on travel. And your solutions are very practical on the ground to close the issue rather than sort of trying to elaborate and sort of drag it. That we very well appreciate it, sir. Thank you so much.
Thank you, sir.
Thank you, and thanks a lot. Sorry for the initial hiccups, but I think overall the availability and connectivity was good. Thank you once again. Have a nice day. and have a better discussion subsequently. I'll be exiting now. Thank you.
Thank
so
you,
much.
sir. Thanks, Nithya, and thanks, Hardik, as well. Over to you, Rupa.
Thank you, Mr. Sriram. Now we will move on to the next panel discussion on TDS issues on domestic payments, including salary and CPC issues and challenges. Um, the panel discussion overview will be provided by Ms. Aarti Raote and Ms. Priya Narayanan. The session is moderated by Ms. Tapati Ghosh, Co-Chair, Direct Taxes Expert Committee and partner Deloitte Touche Tohmatsu India. And we welcome Mr. Srinivas Bidri, Commissioner of Income Tax TDS. Thank you very much, sir. Welcome once again for this session, sir, and for accepting our invitation. And we also welcome the other panelists, Mr. P.V. Srinivasan, Partner and Chief Mentor, PVS Advisors, Ms. Pratiksha Singh, Director, Direct Taxes Herbalife, Mr. Rohan D'Souza, Head of Tax, Volvo India, Mr. Vasan, Senior Vice President, Global Taxation, Hinduja Global Solutions, and Mr. Venkatraman, General Manager, Corporate Tax, Wipro Limited. And now I would like to hand over the stage to Ms. Aarti Raote and Priya Narayanan. Over to you.
Okay, thank you, Rupa. And I hope I'm audible. So we've had a fantastic session. The first session was amazing and really, really practical solutions. And yes, now we go on to domestic taxation. What I have here is maybe some of the topics or some of the decisions which have come in the past couple of years, which I found were really, really interesting and something to be highlighted to the audience. As we all know, employees are given the responsibility of, you know, as collection agents of the government, and it's only appropriate that at this stage we have clarity to do the compliances well. So in the next 10 minutes, I will share a brief overview of how salary taxation has gone about in the coming years. We see a huge increase in collections for direct taxes. It's about 24% increase over the last year. And obviously, I guess TDS has contributed a lot to this kitty. So kudos to everybody who's doing tax withholding and contributing to the revenue. The government has also gone ahead and made a lot of changes in increasing the scope of tax withholding. There's increase in the type of deductors as well as the payments that attract TDS. One of the significant change in the last couple of years is to include individuals and focus the responsibility on individuals to do tax withholding, whether it be rentals or any kind of property purchase. And what we see on a practical note is there's quite a bit of compliance challenges that people face in this, which will, of course, be brought up by the panelists shortly. But now, starting with the changes on TDS, the single largest change which has happened in the last couple of years is the introduction of simplified tax regime in 2020. And this is to enable the employees to make a very, very informed decision on which is the tax regime to be, which is going to be beneficial for them. Obviously, there is stimulators which is provided by the tax department as well as the employers. And despite this push, we did not see too much of a uptick in people preferring to simplify tax regime, and it could be, probably due to the lack of awareness or that the regime was not really favorable to people. And to address this challenge in 2023, the simplified tax regime has been declared to be the default option for the employees for tax withholding. So apart from this, there are beneficial tax rates and the standard deduction that is now available under the simplified tax regime. So given this, it is important for employees to be intimated that this will now be the default tax regime, and if they do not really exercise the option, so they have simulators which is available either from the employer side or even the tax department has provided a very good simulator, so they can avail of these facilities and go ahead and make this choice. Another topic which is interesting is leave travel concession. There's obviously nothing new in the provisions for leave travel concession, but there is an interesting decision which caught my eye here. There's a large banking company where employees have traveled to locations like Port Blair and Madurai, but this is via locations like Malaysia, Singapore, Dubai, Thailand, etc. And the employer was pulled up for granting this benefit of leave travel concession without noticing this fact. So there was, a lax in the verification. And the important observation which was made by the Supreme Court in this case was that if the employees are traveling outside India, automatically leave travel exemption cannot be granted because it's only applicable for travel within India. And the companies actually made a argument saying that there's nothing which is reimbursed for this overseas travel. But the Supreme Court did not think this was a relevant argument. They just held that if people are traveling to foreign countries and this forms a part of the travel which is claimed under the travel concession, it automatically makes it ineligible for this benefit. This is actually not the first decision. There have been earlier decisions in this regard as well, and hence, obviously, the need for all of us to look at verifying documents very, very closely. The other topic is on stock rewards. We are all aware that benefit of stock options is taxable on allotment. And so the issue is on year-end exercises. When people go and exercise at the last day of the year, the stock awards, obviously the processing time makes the allotment happen in the next year. And I think the challenge over here, which most companies are facing, is different viewpoints as to which is the year in which you really have to offer this benefit to tax, whether the earlier year or the subsequent year. And some guidance or some clarity will avoid this kind of confusion. Another practical challenge probably here is the merchant banker valuation. When there is a merchant banker valuation which is required for an overseas share, what happens is that the difference between the sale price and the FAB on the date of exercise automatically gets, accounted as capital gains here because there is same day sale which is exercised by the employee. And while the employee really does not see any gain, the merchant banker valuation is at that time generates a notional gain or a loss for the employee. And this is something which many employees either, report incorrectly or they fail to report because they don't see a real gain here. Another topic or a burning issue, which is taxation of retirement contributions. In 2020, there was a change whereby benefits, employer contributions to retirement benefits like PF, NPS, superannuation in excess of aggregate of 750,000 were going to be taxed. This was simple, but then there are lots of issues which arise on this. One is the sourcing of past data for the employees. The other is where all these benefits are provided by an employer. How do you allocate between the limits for these benefits? So somewhere the employer ends up making a lot of assumptions in this space. And again, accruals to NPS, they're again NED based. So obviously, you can't be taxing those unrealized gains there. There is PF interest that has to be also taxed on this incremental accrual. And as we all know, PF interest gets reported or gets announced quite late in the year. So as on 31st March, the employer is again making some kind of assumptions to make sure that it is complying with the law. The reason why I'm highlighting all of these challenges is that the number of assumptions that one has to make is actually increasing the anxiety that whether this is going to be litigable in future. So anything that we can address this at early stage will really help. Some other common issues which are the need of the hour is determination of whether a new hire is a consultant or an employee, because obviously things are only going to be more complex given that I've got increased freelancers, consultants, part-timers working as a part of my workforce post-COVID.
And hence, there is going to be a question mark as to whether I have to do employer compliances under 192 or whether they go under professional fees. There has been a recent decision of the Mumbai Tribunal, which highlights, which has examined this issue, and there is, what they've mentioned is that you have to check the service contract governance carefully to see whether there's fixed remuneration, termination clauses, designations that are mentioned. Also, the courts have considered that there is substance and there is form, and both need to be aligned in order to see whether you have to do the compliances under 192 or 194, okay, as the case may be. So we have these challenges. In Karnataka specifically, we have a lot of contrary decisions, and this is more specific to payment to doctors by hospitals. So there is a little, what I would say, this is a contentious issue. And some guidance on this matter is going to be really, really helpful out here. Again, the last issue that I would want to place before all of you all is more specifically in terms of, the treaty claims that are made for employees who are either going overseas or who are coming to India, and there is a treaty claim to be made at the time of tax withholding. Many companies are taking this position based on tax decisions and AR rulings. So the law is there, but the challenge is that operationally the Form 16s and the tax certifications, the TDS returns, all of them, they do not have the specific provisions to reflect this. So somewhere there is a doubt in the minds of people. There is lack of transparency. So operationally, if this is eased out, things would be much more better. I think the panelists will discuss this in greater detail in the coming session. But these were some of the topics which I've highlighted, and obviously there's much more to it operationally. So that was all from my side in terms of salary taxation, and I hand it over to Priya.
Thanks, Aarti.
Priya,
Priya,
her thoughts.
About 5 minutes, otherwise, we won't. There are quite a few questions to cover.
Yeah, thanks, Tapti. And Rupa, would you mind putting up the slide, or I can also share it? I do have the presentation, right? So
I have. We will share it.
Sure. So as Rupa puts up the slides, first of all, it's nice to see everybody, so many familiar faces. So hello to everybody from my side. I think the first point is that the government did say in 2018 that we're looking at becoming a 5 trillion economy by 2025, and of course the date had to be revised on account of COVID, and therefore we're looking at 2027 to achieve it. And today we are at a very good stage that we will be looking at 3.47 million as of now, and therefore we are much more closer to the target. Also, the outlook that was set was that we will have 1 trillion in the agricultural sector, 1 trillion in the manufacturing sector, and 1 trillion in the 3 trillion in the services sector. That would be the breakdown of the numbers that we have, which is the 5 trillion economy. Now, having said that, I think from a policy standpoint, we have been very consciously moving towards how we can improve as a economy, and doing business in India, as a report that the World Bank generates, is a critical measure, because I think many countries do look at as how well we are doing on the parameters that has been set by the World Bank. There are about 9 or 10 parameters. I think that we are not on the right slide, Rupa. I don't think these are the slides. So can I just quickly go ahead and share, Tapti, if that's okay?
Yeah, you have it on the screen.
Yeah, maybe these are Aarti, so if you can just go ahead and present.
This was my deck.
Okay.
Yeah.
Just talk it through, Priya.
Yeah, sure. So I will go ahead. So, when we talk of doing business in India, I think there are two critical parameters that are of importance when it comes to taxes. One is the paying taxes, and the other is trading across borders. These both parameters somewhere roll back into how our tax systems, can do better. And from that point of view, as a ranking, we have improved from 77 in, earlier on in 2019 to 63, and 14 notches up in a couple of years is significant. So paying taxes, I think the measures that we have taken, whether it's reducing the tax rate from a 30 to a 22 or a 25% bracket, or improving the manufacturing tax incentive to a 15% rate, are, I think, significant moves. Also setting up single window clearances, whether it's for customs, between the importer exporter, or, the single window clearances for setting up a company in India, including the PAN and TAN related applications, have been significant moves to improve the doing business in India aspect. Now, more closely, if you look at the state-wise collection, I think, and this is where I really wanted to present the chart, Karnataka as a jurisdiction, the amount of collection that we have had in the last 3 years is significantly increasing. So we are becoming a state that is, responsible or is key in collecting significant amount of revenue that is contributed back. Bangalore as a city, last year, we are all aware that, I'm sure the income tax department takes pride in it, that, we probably went ahead of Delhi to be the second largest collecting zone in India. So I think these are the trends that we are seeing from a tax collection point of view, because direct tax collection, in that the TDS collection itself contributes to about 45%. Also from ground level perspective or granular perspective, we've seen significant improvements in terms of the responses that we have had in the last 1 year. Whether any grievance that we raise, any issue that we raise, even if it's as simple as a procedural matter, the response time is so quick. And in a recent instance with the CPC, we got a response in 2 hours as to what is the issue. So that is the kind of improvement we are seeing. I think the only point that I wanted to make before I hand it over back to Tapti is simplification of the rates, if that's something that we can look at, because we have multiple rates today that are there, whether it's a 0.1, a 1, 2, 5, 10, and sometimes it does become difficult, and especially when there's an overlap as to which rate to apply. So if simplification of rates can be considered, I know goods and services are two different buckets, and therefore it's not like to like comparison, but if we have largely two different rates, it will be easier for the SSE also. And as a tracking compliance mechanism, definitely the taxpayers are here to comply and, are more than willing to comply with it.
Thanks, Priya. So that was an overview from Aarti and Priya, who are partners with Deloitte. Just wanted to get on to the panel right away with a quick round of introductions. Bidurisa, are you there? I think you're on mute. We have Srinivas Biduri on the call, the panel today. He was there on our panel last year as well. Really appreciate the support. Has had wide-ranging experience across India, has been posted on assessments, investigations at the headquarters and administration. He's been a vigilance directorate, has handled TDS appeals as well. He's been across India, Chennai, Hubli, Bellary, Mumbai, and Surat. Thank you so much, Bidrisa, for the support that you provide to BCIC. Next is... Thank you, sir. Next is PVS, PV Srinivasan, has been forever a part of BCIC, has been a mentor, a guide on anything related to direct or indirect taxes. Over 35 years of experience in corporate tax, is now the chief mentor for PVS advisors. He's had experience across India, US, Europe, Asia Pacific on corporate and tax structuring, business and company reorganizations, transfer pricing, employee taxation, indirect taxes in India, VAT, service tax, social security issues. The experience just goes on and on. And of course, specializes in both Indian and international direct and indirect taxation. Thank you,
Thank you. Thank you for inviting me.
Absolutely, always. Then we have Prateeksha Singh, who's the director, direct taxes for Herbalife. Has had past experience with ANSA, ANSR Global, has been with Ernst & Young earlier. Again, specializes in international tax, assurance, and banking. Thank you so much, Pratiksha, for accepting this invite.
Thank you, Tapti.
We then have Rohan D'Souza, who's the head of tax for Volvo India. He is has had multiple years of experience, 15 years to be exact, He's also provided consulting services for multinationals and Indian business houses. A lot of experience in international tax, corporate taxation, tax representations, alternate dispute resolutions, and so on and so forth. Currently in Volvo, has been with KPMG and Ernst & Young in the past. We then have Vasan, MS Vasan, who's the Vice President Global Taxation for Hinduja Global Solutions. Professional with expertise in international tax and transfer pricing, apart from other taxation areas. He was with IPCL in the past as a management trainee. He's sorry. And he's authored several books on transfer pricing, audit practices, direct taxes. Come out with a direct tax ready reckoner and the master guide to income tax. Has been a part of several negotiations for state VAT authorities, income tax, IRS for corporate tax matters, and so on. Thank you, Vasan, for being here.
Thank you, Tapti, for giving this opportunity.
Thanks, Vasan. We then have Venki, as we call him, Venkatraman E, who's General Manager, Corporate Tax Wipro, with 16 plus years in India and international tax. Very strong in financial planning analysis, audit, MIS, financial analysis, and so on. Thanks, Venki, for being here.
Thanks, Tapti. Thanks for inviting me. Thank you.
And now let's move into the panel. The way we'll run it is I'll probably just touch upon some of the key issues that we are seeing, challenges that employers are facing in TDS. Hand it over to our panelists who will dig deep into what the issue is, and then pass it over to Bidrisa for some insights on how we can possibly get a resolution for some of these challenges and possibly some of the steps that he may have already taken. The first one, Arti touched upon this topic earlier on. Employers continue to have a challenge in discharging TDS responsibilities in terms of Provident Fund contributions and accretions to employee contributions that have been made. Those limits have been set up a couple of years back, 750,000 for employer contribution and 250,000, which the interest is supposed to be taxed. And the questions that come up are, what are the obligations of the employee? How does it all need to be implemented? And as an employer, what you really see as a challenge, and what are possibly the recourses and recommendations that we could make to the tax department? Now, for this, if I could hand it over to Rohan to maybe dig a little deep into what the challenge really is and continues to be, and then we can have insights from Bidrisa.
Sure. Thanks, Tapati, for this opportunity, and thanks for the introduction. So like the landscape was set by Tapati and Priya about the...
Excuse me. I'm unable to hear. Can you
speak to the mic? Can you speak louder?
So we can hear you. I think Srinivas Bidari sir is saying he's not able to hear.
A little louder. A little louder, Rohan.
All right. Is it okay? Is this okay?
Yeah.
Yeah. So like I was saying, that the landscape has been set in terms of the legislative mandate will change the taxation for provident funds in terms of the excess contribution that an employer does beyond 7.5 lakh and the corresponding interest liability relating to that contribution. Parallelly, there has been a change in terms of the employee interest in the hands of the employee's contribution beyond 2.5 lakhs. So once the liability to tax has been crystallized, there comes the obligation for the taxes to be deducted, withheld, or paid by the taxpayer or the assessee there. Now, what I've understood or examined this change is that there is the obligation on the part of the employer now to make calculations to discharge the withholding tax liability. there are certain challenges which I have seen, heard, and discussed with a few people that I'm aware having these kinds of obstacles, in the sense that there is a formula that has been prescribed by the provisions, by the rule, income tax rules, which mandates an employer to compute the taxable portion of the interest. Now I see that there is more clarity on how the accretion beyond 7.5 lakhs falls into the taxable income. I think that's pretty straightforward. The challenge comes is when the interest component, which is taxable, relating to the portion beyond 7.5 lakhs needs to be computed. There is a formula that one needs to implement. And what I see that industry is grappling with is in terms of the detailed nature in which the computation of interest, their interest income is outlaid. There are certain challenges in getting data or information from the stakeholders, particularly the employees, in getting the right amount of interest that is to be used. That is the formula that needs the interest that has been accrued to the employee's PF account of the current year. How does one get that information? It is obviously from the PF statement, but there needs the logistics of trying to get that out from the employees. And there are several organizations having hundreds and thousands of employees, and it becomes a little bit of a logistical challenge to get that in place in time to do the withholding. There is another angle to it in the sense that employees join in the middle of the year. One needs to get their data, their information to compute this element, which also I understand that one needs to look at the manner in which the computation was carried out in the previous year, which I think employers usually don't give it to employees to, to have a look at, or that's not a record that is handed over. So overall, there is a challenge in getting information for the payroll team to process or compute the taxable interest corresponding to the the PF contribution beyond 7.5 lakhs. This is one part of the exercise that where taxpayers I see are looking for answers. Probably the connected challenge could be in terms of computing the accretion relating to the NPS contribution. As I understand how the mechanics work, the NPS scheme works on an NAV basis. It is difficult for one to ascertain the annual accretion for the purpose of computation. The NAV keeps changing. The accruals of the NPS are unrealized. So overall, while there is a strong emphasis for taxpayers to comply in the best spirit of the law, there seems to be a little bit of lack of clarity on how does one actually do the right thing in right time. So this is, the challenge that I see the industry will be facing, and has been facing actually for the past few years, couple of years, and since the provision has come. And look forward, to the Honorable Commissioner to see if there is any possible solution that the department is thinking about. Is there any scheme that is coming either to digitize this process, whereby there is a backend tool which can automatically compute these interest computations, pull PF statements from backend from the PF portal, or align the previous year's computations? Is there a mechanism or a bandwidth that could be, or a framework that could be put in place so that this becomes a seamless exercise like the other 192 routine withholding that is done? This is what was in my mind that I thought, we place it forward for deliberation and possible resolution.
Bituri, sir, if I could hand it over to you, sir.
Good afternoon. Mr. D'Souza, very nice presentation. You really covered all the nuances involved in this. I totally agree with you. There are some difficulties, and as suggested by you, we will make a note and forward it to the systems who can clarify, and if some seamless way of calculation and computation can be brought up. And if you also made a note, I think you can forward it through the Chamber of Commerce, organizers of this meet. We'll take it with the systems.
Very much appreciating, sir. And in fact, when I was just brainstorming internally, what's the possible solution? I was thinking about the GST network that we have today, which is such a large mammoth system I see that is available to taxpayers in the country. And it suddenly occurred to me, is it possible to do something like that, whereby at the back end things are aligned and then it just pushes data in front for the taxpayer to, at the end of the day, just verify that the computation is correctly done, because at the end of the day, the interest income that is actually accruing to the employee should be the right amount that is going to get taxed. So, that is the, what is it possible outcome I was thinking about if technology can be brought in to resolve this.
Yeah.
So the another connected question that I have is on the the withdrawal time. So basically, the issue that I've been seeing is that the employer contribution beyond 7.5 lakhs gets taxed in the hands of the employee, right? Year on year, it goes on happening. Then subsequently, there could be a situation whereby the employee wants to withdraw that contribution before the time prescribed for non-taxability or exemption. Now, there could be a situation whereby the PF authorities could withhold tax at the time of withdrawal. And we were just thinking that would result to a situation of double TDS, or rather double withholding. Once at the time of initial accrual of income, when it crosses the 7.5 lakh threshold, and thereafter at the time of withdrawal, when it is withdrawn before the prescribed time, I think it's 5 years. I thought that this would sometimes be a cumbersome process, in the sense that I was thinking of a situation whereby some employees may not even be aware that they have been hit with a double TDS within a gap of 5 years. So is there something that we can think of as a resolution of how this situation can be dealt with? Is there a provision that is coming up? I mean, is there a way that a provision can be brought in to bring in clarity, or some kind of passage in the regular salary circular that gives guidance to taxpayers and industry how to deal with this situation?
Yeah, I understood what you are saying. If you can, that even regarding that the other initial thing you told regarding GST network, I don't know how it works, because I've never been privy to it. So, but if you are
So we are unable to hear you. I don't know if it's only me.
Yeah, I think we can't hear.
Tapti, we can't hear, sir.
Vidri, sir? Rupa, could you connect with Risa and find out?
Yes, I'll just speak to him.
Sure. What we could do in that case, there was some additional thing, Rohan, as we discussed earlier, there were some additional questions with regard to interest on employee contributions to PF as well, where clarifications were needed from the tax department. Maybe we could club those with these questions as well and pass it on when we are collating everything at the end of it.
Hello?
Yes,
yes,
sir.
Yeah, sorry, I think there was a power cut. So
no worry.
As you said, if you can give us a note, or you can deliberate and make a formal proposal. Because what you are saying is something that has to be taken up at a central level. So we can forward it.
In fact, we were just discussing that there are some additional questions related to interest on employee contributions to PF, how the threshold is to be mapped, and so on. We'll include those questions as well, and provide if there are recommendations that the members could provide, we'll add those in as well. If I could just move to previous, we know that there are persistent challenges related to grant of tax credit related to mergers, business reorganization, and so on. Can you call out some examples and scenarios of where these challenges lie? If there are any solutions from an operational perspective as well, CPC related, maybe you or if there are challenges from that perspective, and then maybe we can some insights from Teresa.
Sir, I may place the overall difficulties in 2-3 compartments. Sir, in an Indian scenario, a merger takes place, there are 2 important dates that become relevant. One is the appointed date, the second is the effective date. Appointed date is the date from which the merger actually takes place, in the sense the 2 companies are merged and there's the amalgamated entity that comes into life. The transferor company is effaced from the statutory record, but the transferring company survives. The effective date comes much later, when NCLT or the High Court in the earlier days passed an order and that order gets filed with the ROC. There are many occasions when between the time of appointed date and the effective date, many tedious transactions have happened in the hands of the transferor company, which has not yet flown into the transferring company. But finally, the consolidated income will have to be returned by the transferring company. It has to be assessed in the hands of the transferring company. And the tedious credits which are there pertaining to those income must also be granted in the hands of the transferring company. At this point in time, as we speak, Section 170A was introduced to file a modified return, but this section has come into effect from 1422. I don't have a personal experience of filing a return under 170A, so I don't want to comment on it. Possibly the TDS credits are flowing better after 14/2022. But before that, the TDS credits are all stuck up. The other one also, sir, is that if there are TDS aspects which have arisen in the hands of the transferor company, which remains unreconciled in the hands of the transferor company, and finally they are resolved for whatever good reason, how to grant the credit in the hands of the transferring company. My experience is that when we have dealt with the department on time to time on quite a few mergers, I don't want to say all of them, but enough to say it's a sample which can be looked at. There is no clear demarcation of responsibility, or there's at least some confusion, as I understand. I do not know whether it lies with the JO to ensure that the credit is granted, or it lies with the CPC to grant the credit. I would suggest, if I have the discretion to suggest, is that if it can be placed on the JO to grant the credit, and he must ensure that he works back with the CPC in whatever required manner, it will help the credit. Today, many assessees are going to the court only to solve the issue of credit, how to grant a credit. In the sense, neither the department would like to dispute it, nor the assessee would like to dispute it, but nevertheless, the credit remains ungranted. Can there be a mechanism which can be used so that the past issues can all be solved? I'm very sure it's not a minor issue, and neither the department would collect a tax which is already collected from one of the two, either in the transferor company if it has collected. I don't think the department will be interested in collecting once more tax on the transferring company. I request some kind of a suggestion which will resolve this issue on grant of credit in a business reorganization. Sir, I have one more suggestion which may require some clarification rather than anything to act. In a scheme of business reorganization, there are thresholds to be applied in respect of TDS deduction. Particularly, this will be applicable to small and medium companies because very often their payees do not cross the thresholds. Whether the threshold should be separately applied to the transferor company and the transferee company, or the threshold will be an amalgamated one when the test is applied for the threshold. My own suggestion, sir, being a transaction tax and not a tax on the assessee, I would think that the threshold should be separately applied, but clarity is not emerging on this aspect. I would see if clarity is some kind of an issue. I am very sure to say that it will be on a threshold will be applied on a combined entity even at a retrospective date will be impractical to handle. Possibly the clarification will have to be that it will be threshold will be separately available. And this is how the GST law also applies. If I have to give some insight on the GST, that even the transaction between the two companies would be liable to TDS because those are not the companies existed separately at that point in time. So having regard to all this, some kind of a clarification that the threshold will be individually applied till the amalgamation is effected. I think that will be a good clarification to have.
Regarding the first point you made, as you said, it's a little complicated, but I want to share that in one or two cases we have been able to do that with the help of CPC. But as you said, if some way of doing it automatically by the CPC itself, then it will be better because AOs are overburdened with this work and it's little difficult at AO level.
The only difficulty I may point out, CPC does not encourage any personal visits at all. We cannot enter CPC at all. That is the norm of CPC. But a JO can be visited, he can be assisted, he can be provided all the details which he may seek from time to time to ensure that the credit is granted. While CPC is an automated mechanism, but ability to approach the CPC has been difficult, or they don't encourage us coming to them. If I have to.
No, it may not require physical going if they can provide a portal where you can upload all the things and it can be done. So if you give a suggestion, a comprehensive note, we'll definitely forward.
Well, fine, sir. We will provide it, sir. I'll use the base.
I'm in agreement what you're saying. So if you can give a note, we'll ask for a clarification from the board.
Correct. Sir, the last issue I may just want to take it is on computation of interest under 201(1)(a). My understanding is that if there is a default in compliance with the TDS provision, till the default is cured, the interest would apply. That is, the payment should be made from the date of default till the date of curing of the default. By making a payment of the TDS, the interest will be computed. The question is, when is the default occurred? This is important when thresholds are prescribed. Suppose a company is under the belief that the threshold may not be breached and the vendor is small and they don't deduct tax at source, but subsequently the threshold is breached for whatever reasons that the number of transactions have increased, the volume of transactions increased, then obviously the catch-up TDS will also happen. My own sense is that default in compliance should be reckoned from the date the breach of threshold has happened. Is there a way this data can be captured? This may not be relevant for very large companies which do not have to bother about the threshold because upfront they know that the threshold will be breached during the year. But certainly for certain transactions where there's lack of clarity or the payee contests that he doesn't have a liability to TDS and therefore the payer is not required to deduct tax and so subsequently it breaches some kind of a recently, sir, I may just point out just for authority, the Singapore Airlines decision of the Honorable Supreme Court said that it should be in the failure to deduct charge should be at the point of failure. At what point the failure is to be deducted should be the one which will be very relevant. I would possibly submit to you, sir, that kindly consider when the breach of threshold has happened, that would be the point of the failure and not the original date when the first payment happened.
Yeah. We will take, if you give us a note, we'll take up with that. Because this there is an interpretation of law issue and uniformity is required for the whole country, for us to decide.
Okay, we'll present it to you, sir. I think I placed it only in some kind of a communication, whatever we could now. We'll bring the legal literature also into it.
Okay, thank you.
Thanks, PVS. I'll come back to you. Vasan, if I could turn to you now. we've had this, challenge for many, many years now, where most entries are passed at the end of the year when we are finalizing our accounts. So provisions are made and then they are reversed in the next accounting year. And the question comes up as to when the TDS provisions have to be complied with. Would they need to be done at the time of accrual when you don't really know who the vendor is or what the actual amount of payment is and so on? Or should the TDS really be complied with when an invoice is raised? Could you just elaborate, give some specific examples on this, and then we'll get insight.
Sure, Tapati. Thank you so much, sir. This has been going on for quite some time now, from IBM case in Bangalore from 2015, and there are other cases also which have been set in place in 2017, 2018, and in various other jurisdictions as well. So if we step back and see the accounting standard for the provision to be made and to be certified by statutory auditors of companies, it's more an estimation or more of a budget to actuals tallying. In fact, as even when it's a listed company on a quarter-on-quarter basis, we do have the budgeting and actuals, and that is also being presented as part of the annual reports or quarterly reports which we publish. And so to have the true and fair view and to capture whatever is the estimated expense for that quarter, irrespective of whether it has crystallized as liability or not, we do recognize for the sake of the accounting standard as well as for satisfying the statutory auditors who certify our accounts. So given that this is more of an estimation of an expenditure, sometimes it may or may not have the receiver's name also attached to that. So given that if the liability is not crystallized and the payee's name is not identified, will it be fair to have a TDS deduction and remitted when we are going to create this provision and on 31st March and reverse it on 1st of April in the system itself? And maybe actual invoice may come sometime by 15th of April, which we may subject it to TDS deduction, obviously. So given that this has been a recurring issue and it has always been brought to the notice of the department as well from time to time, but nevertheless, a clear direction has not emerged. Even though there is no tax leakage as such, whether it's on 31st March or 15th of April, the TDS rate being the same, there is nothing going to be called out as a leakage from a tax department perspective. So given that, can there be some solution and the rate being applicable remaining the same?
I know the long history of litigation on this issue, and being such a senior and expert on this, you may be having better idea. But as on date, as the law stands, you have to make TDS. So it is better if you can, if the matter is raised to the concern for a clarification or a provision in the rules or something. So I agree with you that litigation should end. But our stand is that provisions, TDS has to be made in the provisions. On the
Yes, sir. If we don't deduct TDS, then there is a consequence of penalty and interest. Yes. So given that a clarification from CBDT, given that there is no tax leakage as such. So if there is a tax leakage or there is no TDS being applied for the expenses which we incur, then obviously, yes, that is not a right approach. Given that there is no tax leakage and we are going to deduct TDS in the subsequent invoice on actual basis, and there is no major difference, as I told you, in the rate also, given that that should not affect the status quo as such. It's more of putting records straight and giving convenience to the taxpayer or tax deductee in the first place.
Sure, we will raise it as a recommendation, Vasan, as Preeti sir mentioned.
One more point on membership fees, which is also a very minor one. Very much classified into two buckets, in fact. One as a managerial, technical, or consultancy service. If we call it so, then TDS is applicable. Or if we call it as a contractual obligation, also TDS is applicable. But when it is treated in line with the characterization of donation, there is no TDS applicable. So what is the characterization when I'm going to pay that membership fee on a year-on-year basis to a trade body, which is going to do for the common interest of the people, being a mutual trust like an association. So will this be subject to TDS? Of course, we understand that if there is any technical approval or like a trade promotion for exports, we need to get certified, then that comes into technical or professional service, which is subject to TDS, which we understand. But otherwise, if it's more of a regular routine a membership fee for running of the organization or meeting the administrative cost of the association, which has been set up for a common interest of all the business and trade bodies attached to that. So will there be a TDS applicable? This is a very minor one, which has been going on for quite some time as well. So a clarification in line with what I just now narrated could help us resolve this issue.
As already told, we can take up the issue. We will forward it to the board and for a clarification. If they deem fit, board deems fit, it may issue the.
Thank you, sir. Thank you so much.
Thanks, sir.
Venki, if I may turn to you now.
Yeah.
It's common industry practice that individuals have provided corporate credit cards to take care of official expenses while they travel, or for other business-related expenses. From a TDS perspective, what are the challenges that you foresee or are actually facing on the ground? If you could call those out.
Sure.
And if there could be possibly some solutions that you could recommend.
Sure. Thanks, Tapti. Sir, in fact, this is one of the common practice of the industry, sir, to issue corporate credit cards, which are basically to meet for the employees, which are designated for the company, which is given to the employees of the company to meet the business expenditure when they are on travel mostly, which could be your hotel expenses, which could be a rental cabs, or which could be the flight tickets. So at the time of payment, right, and when the card is swiped, there is no option for the employee to deduct TDS because there is no option which is provided at that point of time, right? And in fact, if I go back and read the section, it's 204 says person responsible to pay. So who is responsible to pay, right? And if I kind of explore a little bit on as to when the TDS liability arises, right, which is either at the time of credit or payment, whichever is earlier. So how do we see these instances in terms of whenever a corporate credit card is used and it is swiped and the payment is being made and the payment is and that such kind of an expense is possibly requiring a TDS? How do we meet the compliances and how do we look at the compliance when those kind of payments are being accounted? I think that is the broader question we have, sir. And since there is no mechanism, more specifically when there is no mechanism to deduct TDS at that point of time when the swipe happens, is there a suggestion, sir? Is there a thought in terms of how is the corporates expected to meet the compliance in those instances?
A point well taken. So if you have any suggestion, you may give, or we will take up with the board. So right now I am unable to understand or give you any suggestion on this regard. It is very clear that TDS has to be made. How to do it? What is the mechanism? We can write to the board for some clarification.
So the only point there, sir, is that definitely at the time of the card is swiped, right, there is a very limited option to make the TDS. because the way in which the transaction happens, the center bank, receiver bank, and how ultimately the vendor is settled, right? This is a chain of transactions, and there is no single payment which is being made. And I don't know whether if we have to go back and see whether it is a credit or payment, whichever is earlier, whether this should be treated as a credit based on the suspense account, like what we have in 194C. So, I mean, absolutely, there is not a very clear answer that is there in terms of how the compliance has to be made. So maybe the question also emerges from that perspective, sir.
Understand. So that, as I said, it has to be addressed at a central level, national level. So we can.
But one point is quite clear, sir. In a sense, whatever is the because these are more of more transactions when it emerges, but the mechanism to deduct TDS, right, at that whatever way in which the TDS deduction has to happen at the time of payment or credit, this transaction probably doesn't fit into any of those steps that we may have to follow in deducting TDS.
Okay.
In fact, the follow-on question from that, Tapti, I'll move on to the next one, is that which is very common, sir. In fact, it was touched upon in the previous session also, which is on the reimbursement of expenses, right? I mean, we know that quite a few instances are there where the reimbursement of expenses happens when we make payment to the vendor. And in fact, there was a 1995 circular which said that what is covered is sums paid. So if the reimbursement are part of the invoice, then probably the TDS has to be deducted in the overall amount and not on the cannot be excluded, right? But what is quite clear is that if I go back to the charging section 190, it very clearly says payment of income. So reimbursement per se does not partake the character of an income, while of course the section says any sums paid. How do we look at that? And two is that if it is part of the same invoice and any sum paid is what is covered is as part of the charging section. But if I raise reimbursement as a separate invoice, then can we make the payment without with being subject to TDS? I think there is some thoughts or some clarity on that while it addresses if the reimbursement are part of the overall invoice, but if the reimbursements are separate invoice, can that be looked at as an option to pay without TDS?
When it is part of overall invoice, the law is clear now. It has to be done under the relevant section. But when you are claiming it, you are paying it under a separate invoice, then 194R will be applicable. So, and the circular is also clear. Circular 12 of 2022. You may refer to question number 7. It's very clear in this. So when it is a part of composite bill, either whatever 194J, if you are making payment under 194J, that rate has to be applied. And if it is part of a separate bill, then it has to be brought under 194R.
And whatever correction and whatever clarification which it is subject to 194R can be followed through.
Yeah, this part that you kindly see question number 7 in the circular number 12 of 2022, dated 16 June 2020. So, one second. No, question number 2. You can sorry. No, section. (1995). Question number 3. Sorry, question number 3 of circular number 18. Kindly see question number 3 of circular number 18, dated 13 September 2022.
So are you, sir, referring to the point where it was clarified that for reimbursement of out-of-pocket expenses, there will not be a liability for reduction of tax under 194R, provided the reimbursement of OPE was already part of the consideration and invoice bill on which taxes already under 194.
See, if it is part of the same bill, it is to be, it attracts TDS under 194J.
Correct.
If it is a separate bill, then 194R should be applied. I think the question number 3, shall I read it out?
Yes, sure. I mean,
question number 3 of the circular, 13 September 2022 dated. I think that is the question, if I understood correctly.
If it is already included in the part of original bill, then it clarifies that it will not be, there is no additional benefit.
Question number 7 of the earlier circular number 12. And then from there, some follow-up questions have been addressed in circular number 18 of 2022, dated 13 September. In that, question number 3 is exactly what you have asked, if I am right in understanding what you have asked.
So if I may probably draw one additional point here, if I'm not wrong, the question number 3 addresses a point where if the out-of-pocket is already included as part of professional fee, then there is no further benefit which requires the tax deduction. So does it mean that the reimbursement, if it is made separately?
Yeah, that.
You mean it may have to deduct?
Yeah. Is that, see, the idea is whatever is paid should be deducted. Whatever is paid should be subjected to TDS. So if you are already doing under 194J or 194C, then on that, as per this clarification, not required. The opposite is when it is done as a separate bill on a separate invoice, then 194R need to be done.
Okay.
So does it make sense to also refer to circular 12 of 22, wherein they had, there's a distinguish between in whose name the invoice is raised for pocket expenses. And if it's in the name of the service provider, then 194R will be applicable. If it is in the name of the service recipient, then 194R will not be applicable. Maybe can we look at that as well?
These two circulars are very comprehensive. So we may follow the same. If there is any confusion or some clarification is required, if you feel, you may give this note. We will forward it as part of the note.
Got it, sir. So I will summarize it this way, sir. So if it is a reimbursement which is part of the original bill, then obviously 194J or whichever section which is.
That is what the question number 3 says.
Yeah. So if it is a separate bill, then 194R will apply, and 194R, if there is an exclusion or if there is inapplicability of 194R which is specified in any of the circulars, then that will follow. Then the TDS consequences, if any, will follow accordingly.
Yeah,
I think
both circulars are very clear, comprehensive. That I don't think any confusion is there. But if somebody facing a confusion, some interpretation, we can
deliberate and get back, sir. Yeah, in case there are questions. So since that's a good segue into 194R, Pratiksha, if I may turn to you, I mean, from the time that the sections come into play and even post 12 of 22 and 18 of 22, there are challenges that continue to be there for the taxpayer. Do you want to elaborate on what those challenges are? Because this is definitely one area where we believe we will need answers, and possibly if there are recommendations.
Thank you, Tapti. Very good afternoon to everybody. Good afternoon, Vetri, sir. So like Tapti mentioned that 194R, an extension of the TDS provisions to benefits or purposes given in the course of business, a recently introduced section much needed to ensure that the income envisaged by 28(4) is brought in the ambit of tax. However, as we all are aware, given the fact that this is very new, the industry is grappling with some teething issues around this section. And given this forum here and the presence and your presence, Midri sir, we would like to just leverage this and try and seek clarifications around some of the practical questions which could stem out of these provisions. So first thing which I would like to check with you is, just bring to your notice is that when we are talking about these provisions, we are talking about taxing a benefit. So say if there is, and this benefit is something which is not a regular business activity, it is something to do with leisure or any other compensation over and above the regular compensation in the course of business. So suppose I have undertaken a leisure activity where for all my vendors, whereby that benefit becomes taxable in the hands of the vendors. There's a challenge that could arise with respect to timing of taxability of the benefit. So going by the intent of the law, the benefit should be taxed at the point in time when it is given. Suppose I hold the event in this month, it should be taxed as an income for this month. However, practically what we see is by the time the event is closed, the invoicing is closed with the vendors, it takes a couple of months. Until the time the invoicing is closed, I will not really know the exact value. So how do I implement these provisions in such situations? Because if I look at TDS today, it would be on estimated value or something which is not really finalized. So how do I tackle this to ensure that there is compliance at the same time? There is not an interest burden on the assessee.
I doubt any such circumstances. If you are holding an event, I think all prices, all costs would be finalized before holding the event. I really
so typically there is a budget that is there, but and that also depends upon the size of the event. The smaller size events, it will get concluded very quickly. But if you have a large event, or say an event in multiple locations, especially for a company.
I'm unable to anticipate any such situation, but if you feel some people are really facing such things, so we can take it up with the board and some clarification or some mechanism to do that to TDA. But ideally in the year in which it is held, it should be done as per law.
Yes, it will happen within the year, but may not happen within the same month.
Goes beyond.
Sure,
I don't foresee any such situation where they don't know the cost involved. But if there are some real difficulties, we can take it up.
Sure, sir. So similarly, is there, do you think it would really help the industry like we have in TDS provision, a facility for someone to get a nil or a lower withholding certificate, introducing something similar for 194R as well? Do you think that is something which would help the industry, and is that something which could be looked at by the department?
No, we are not looking at it. The data is also very meager before us. So we can't really comment on that.
Okay, sir. So another question which I had was, so if I look at the FAQs, the FAQs clearly carve out that any business event is not really subjected to 194R. But if there is a leisure element in the event, then the leisure element gets subjected to 194R. So for the sake of discussion, let me just create an example. If I'm doing a business event for all my vendors, say it's a 3-day event. The event per se is not subjected to 194R, but on the last day, if I organize a party for the vendors, so instead of giving them a regular dinner, I organize a party for the vendors, which could be a little extended dinner, or there could be some artist performing there, going strictly by the rules or by the FAQs in black and white. This leisure component on the last day is something which could be subjected to 194R. But practically, how do I determine that? It's very difficult to carve out the cost of that one event. And also if someone is not going for the event, but having a regular dinner, the regular dinner may not be taxable, but the event is taxable. How do I practically determine this and bring this to the tax net, sir?
I don't see how it is not. You will be knowing the cost of that event now, whatever cultural or leisure event you are having. The corporate will know when they are costing the entire thing. They will know the element. Each element has how much is the cost. And if
so what I'm
really
trying,
possible, we can take it up with the board. But personally, I am not convinced that the organizer will not know the element cost involved in particular event.
So it's not just the whole event. I'm saying one meal is a party night.
Yeah,
and typically I will have the entire package. So how do I?
In that difficulty, we can take it up some formula or something. We can take it up with the board, which is empowered to give clarifications.
Sure, sir. So similarly, the FAQ clarifies that if we are taking services from so say basically if we're having social media influencers who are doing advertisement for us, and whatever is the product of the company given to social media influencers, if it is not taken back, then that is subjected to TDS under 194R. That's what the circular clarifies. However, here again, there could be a practical challenge because taking it back every time from the influencers may not really be practically feasible. So is there a solution around this, or is there something that we could do? And it's not always possible that all my products the influencers are really using. It may be something which is not really of value to them, but it's not possible for me to take it back from them. So what do I do in these cases? So how do I again ensure compliance is what we are looking at?
If you are unable to take it back, then we have to do TDS. I don't see any way out of it.
So, but look at it from the recipient standpoint. The product may not really be something which he or she is using. So it's not really a benefit for them.
It is very difficult to provide for such things. There are infinite ways the businesses can be a business.
True, sir. So any solutions on how a business could deal with such stray cases? What is the practical way out is something which would help?
I don't think so. I don't think there is any solution. The Act is very clear. As again, board can take it up if there are many, if it is convinced that some cases are really require intervention, but I really don't see. And if they are not using, I don't know why they will not give back.
It's not about they not giving back, but practically for the company to reach out to everybody and ensure it is collected back. The administrative time and cost may be much more than the price of the product.
If any difficult cases are there, we can take it. But I'm not convinced personally. So.
Okay, sir. A similar related another question that I have is again with regard to business events, the FAQ clarifies that travel cost 1 day prior and 1 day after the event is not subjected to 194R. Does this mean that that the company has to track the travel dates of all the participants? And if yes, then going one step further, if someone decides to travel 2 days before, how do I tax that benefit? Do I just take the cost differential or do I tax the entire value? Any thoughts there in terms of how do I tax it?
These are issues your difficulties. We can take it up with the board. If you give us these notes, we'll forward it.
At one point in time for TDS provisions, when there was a lot of overlap and if there was a lot of ambiguity, there's to be an FAQ that was released based on different scenarios that a taxpayer may be facing. Maybe an FAQ for 194R is really, I think ultimately it has to be simple to implement. So otherwise there are going to be a lot of headcount the companies will have to put in place to be able to track products coming back and to really, I mean the sense is that everybody wants to comply, but there has to be ease of implementation. So that is the whole issue. So if that can be
already, as you say, there are 2 FAQs issued circular. So if you think there are some scenarios which are not covered by those FAQs, we can take it up with the board. Let's
pick this up amongst us. We don't have too much time, so maybe we can just switch to some CPC issues, Bidri sir, if that's okay with you.
No problem. The CPC representative is not there. So in that CPC related things, we can just consolidate and forward it to CPC. They can handle it.
Okay. Then maybe there are some overlapping areas we can possibly see whether we can raise it with you. And maybe PBS, if I can turn to you today, I have a tax which needs to be deducted as, I mean, there is a TDS and there is a TCS on the same transaction on two parties to the transaction, the buyer and the seller. And, there is a little bit of relief that has been provided, wherein, as far as the seller is concerned, to say if TDS has been done, then TCS has to be collected. You want to just maybe dwell on the challenge PBS for Bidrisa's thing, and then
Sir,
find a solution.
Sir, there is provisions are overlapping. The question is how to prioritize.
Which section are we referring to? Which section?
206 1H, 206 1H, and 194Q.
Oh, yeah.
Both are concerning transactions in goods and above 50 lakhs. The thresholds are the same, the rates are the same. The question is which one will take priority? How will the payer and the payee organize themselves? In what mechanism? And there are certain unique transactions which may happen. For example, if there are receivables and payables between two companies, trade receivables and trade payables, let me clarify it, because if it is loans, it could have a different repercussion. Then obviously the two companies may square off these transactions, saying that, okay, I don't have to pay you, you don't have to pay me, we square it off. These kind of situations, we do not know how the TCS or TDS issues will take priority. My own sense is the law clearly says that if there is a TDS, TCS will not apply. But at what point the TCS and the TDS will look up? For example, I'm very clear, if I have to buy a car, I'm going to a different section just for illustration, I'm giving it to you. The car vendor would possibly send an invoice which includes TCS because there is no overlapping. There's only TCS and he will take it and he will close it. But if there is an overlap, how do you look at it when the two sections equally apply? But the obligations shift between the payer and the payee. And there are unique transactions where the payments are settled in different mechanisms other than through cash and bank payments. Can we look at some kind of a clarification as to where the responsibility will lie? Because there are severe consequences. There are interest and penalty and even disallowance. If there's a failure to deduct, then there can be disallowance also in the payment. And finally, the revenue should not suffer. At the same time, the industry should not be scratching their heads to find out which one will apply.
Any specific instances if you...
I did give an example of the trade receivables and trade payables between the two companies getting squared up. I can cite one example immediately for the call. I will try and see whether I can get the views of other industry participants to see whether they have other difficulties too, and then we'll bring it to
194Q provision is there.
Yes, sir.
Both that you are facing problems.
Correct. Both sections have some kind of a provision which says that if TDS is applicable, then TDS is applicable and TCS will not apply. I think the law has set the priority quite clear, but in a coordinated mechanism, after all, the responsibility is not unified. How do you separate the responsibility and what the failure should not happen on both sides at the same time? And that is also an anxiety of the industry, if I have to say. It's not that I have not deducted tax at source and the TCS also has not happened. That's not a good situation that both will be vulnerable to the consequences under the law. So we will bring some situations which I talked about, the trade receivables, where there's no actual payment, but it's a settlement through book entries, if I have to say. And the book entries are allowed by law. It's not that I'm looking at a book entry which is not permissible under the law. And because we can adjust trade receivables and trade payables against each other, that should be permissible.
To tell you frankly, we have some cases.
Yes, sir.
Where they have shifted from TCS to TDS, 194Q.
Okay.
And we had a discussion with them. They have not faced any such dilemma. So I'm unable to understand. So if you can make it more clear with help of some specific instances, well, that will be useful. And I
will bring it to BCIC, the issues I have raised. I will request BCIC to add from other members if there are difficulties.
Yeah, because there are infinite ways business transaction happens. Law has to also evolve and mechanism also So and board, as you know, is very open to such suggestions.
We will be happy to fix it in one of the two parties in our recommendation. And if
That's,
it's acceptable to
yeah,
the board,
understood.
It's for the seller to know at what point in time. I mean, how will he know whether TDS has finally been done or not? And and if the TDS does not happen, he's ultimately will have to face interest and penalties. So it's difficult to kind of. There has to be a very good coordination, as you mentioned, between all of the parties, and when the volumes are huge, it becomes a challenge. Venki,
sir, I may only give one particular practical feel of there. Most of the transactions are processed by people who are trained for processing transactions. They are not so intricately knowledgeable in the law. So as long as it falls into set patterns, they do, because there's a SOP given, they adhere to it. The moment it falls out of the pattern, then it becomes it will even go beyond even recognition, because the volumes of transactions are large. They may not even know that such an event has occurred. These are all because shared services are used in a modern day context of bookkeeping. And if it is not captured at the point of transaction, it will never be captured at a later point.
Venki, if I on a topic again on 194Q, what happens if you have a bundled invoice? So supplies,
goods plus warranty.
Yeah, if you can just
So
touch
that's a
upon.
very practical. That's a very practical situation, sir. When the seller sells goods plus warranty, right? Then I have a situation where I have to look at which is the section under which I have to deduct. I think, should I be following the predominance in that case, because the value of goods is high and the warranty follows through? Should I be then complying with 194Q than going doing anything else? Is that the practical call to take?
No, you raised a good point. I think it's better to wait for clarification, take up with the board, and then wait for it.
One follow-on question, sir, because now 194Q has been discussed enough. I have last one question on 194Q. Of course, it specifies turnover limit, right? Preceding financial years, in order to determine whether the same exceeds 10 crores, right? Should we be including the indirect taxes as well, which is GST, in computing that 10 crores? Because in fact, there is a Sinclair Murray decision of the Supreme Court as well, which probably can be looked at differently, because that was under the earlier regime of sales tax, and with GST now coming in, should it be any different? Should the GST be included at all in the turnover computation, or it should not be included? If there is some clarification which can be given on that, it will be helpful, sir.
Yes, we can raise that all these issues to the honorable board. Maybe take up the call.
Sure. We are almost at 1:30. Just wanted to end the panel with a vote of thanks. Srinivas, sir, thank you so much for your support. I mean, I seriously didn't have to go to you a time.
With me, my additional commissioner also sitting here. Just you.
Thank you so much.
Interaction, madam. Thank you so much.
Thank you.
Thank you for being on this call. Give us a lot of strength, really, to be able to members have challenges, and if there is a one-stop shop that we can go to for solving those issues, there's really nothing like it. Thank you. And of course, thank you to all my panelists, PVS sir, Vasan, Pratiksha, Venki, Arti, Rohan, Priya. Thank you all for being on this call. There is follow-up action, and I'm definitely going to be back at you for collating for the questions and the responses where Preeti sir has asked us for.
Thanks a lot, sir. Thanks for the patience.
Thank you so much.
Immensely value your session.
Thank you.
Thank you, sir. Thanks a lot.
Thank you.
Thank you.
Thank you, sir.